Yay. So if you would all flip, please, to page 87 of your manual. We're going to pick up now with line 15 of Form 1040, which is where we report IRA distributions. That is, when we take money out of our IRA and have to report it as income on our tax return, that income is reported on line 15 of Form 1040. And of course, in 2010, you were allowed to take money from your IRA and roll it into a Roth IRA. And normally that triggers a taxable event, assuming you have no basis or only partial basis in your IRA. If you take money from an IRA and put it into a Roth IRA, you realize income at the time of that conversion. But for 2010 only, taxpayers had an election of deferring the reporting of that income for tax purposes until 2011 to 2012. So what that means is that in 2010, for example, you could have a taxpayer who took $10,000 from their traditional IRA, and assuming they had no basis in that IRA, they should have reported $10,000 as income on their 2010 return. Even though it was rolled over into the Roth, Roth contributions are always after tax. So if you take it from a pre-tax account and roll it into an after-tax account, it means that that rollover becomes taxable. But for 2010, that $10,000 could not be reported in 2010 as an option. You could say, I'm not going to report it in 10. Instead, I'm going to report it in 11 and 12 in equal amounts. That would be $5,000 in 2011 and another $5,000 in 2012. And it's an incentive for taxpayers to roll money from tax-deferred accounts to another kind of tax-deferred account that has different tax benefits associated with it. So there was a lot of that went on. As a tax preparer, I've really never looked personally at Roth IRAs with that much favor, but investment people love them. Investment advisors are always telling their people, put your money in a Roth IRA, because even though you don't get a deduction when you put the money in, later on when you retire and take the money out, you don't have to pay tax on it. And they're looking, that is, the investment advisors are looking many, many years down the road. And in some situations, for some filers, that's a good deal. But for many filers, it's not a good deal. And the reason it's not a good deal is, let's just suppose you have an IRA with your life savings in it at $80,000, and you're 60 years old, and your investment advisor says, oh, roll it over into a Roth IRA. So you roll it over. And now at today's income level, in today's dollars, you're paying tax on $80,000 of income so that you don't have to pay tax on it over the next 20 years as you take it out. Anyway, lots of investment people think that that's a good idea, and so they talk their clients into doing these Roth conversions. So, and the federal government seems to want them to do it too, but I'm assuming because it gets them to report income today and help balance the budget better today. I think that's some of what's going on there, again, at the expense of the future. In any event, there was a push for this in 2010, and because of this push, we're going to have people in 2011 and 2012 reporting income from conversions that took place in 2010. This is a repeat, to a certain extent, of a similar thing that happened way back in 1998 when the Roth accounts first came into being. At that time, it was a 4-year reporting process. You could spread the tax over 4 years. And ever since 2002, it's been at the same time you roll it over. But for 2010, it's reported over a 2-year period. And because of that change, 8606, the Form 8606 was revised for 2010. It's revised again for 2011, and it will be revised a 3rd time for 2012. So today we're going to take a little bit of a look at Form 1099-R and also Form 8606. So we're going to take a look at 8606 Part 2. Part 2 of that form was revised for 2011 to provide space for reporting the taxable part of a rollover conversion in 2010 if a Roth distribution is taken in 2011. So it's a very specific situation. You did a conversion from your IRA in 2010 to a Roth IRA, and by the way, it was also possible to do the conversions from 401ks to Roth IRAs. It wasn't only for IRAs, but you could also do it from simple plans and SEPs and from 401ks. Pretty much any of those tax-deferred accounts, it was possible to do that rollover. So the 8606 has been revised to accommodate that. But let's suppose you did that conversion in 2010, and then in 2011 you pull the money out. Or in 2010 you did the conversion, and in 2010 you pulled the money out. I had a client do that real early in the tax season last year. I did a Roth conversion, and then I took it out of the Roth. That made me scratch my head. So it took some figuring out, but we will have the same type of situation going on now where a person does a conversion in 10. They're supposed to report the tax equally in 2011 and 2012, except in 2011 they pull money out. Then what? So I have an illustration for you. So here we have an example. In 2010, Jenny converted $10,000 from her traditional IRA to her Roth IRA. She had no basis in her traditional IRA, so the rollover is fully taxable to her. And she received the illustrated 1099-R in 2010. So you can see this is a 2010 1099-R, and it showed a gross distribution and a taxable amount both at $10,000, and the distribution code was G, meaning it was a qualified rollover. So we move over to the next page and take a look at her 8606, or at least parts of the Form 8606 she filed in 2010. Jenny decided not to report income from the conversion on her 2010 return. She completed Part 2 of her 2010 Form 8606 as shown below, and you will see that on line 16 she reports the conversion or the rollover amount in the amount of $10,000. And she is not making an election on line 19 to report any of it in income for 2010, and is instead electing to report it in income in equal amounts in 2011 and in 2012. And you can see line 20A says amount subject to tax in 2011. This $5,000 is the amount that would be reported on line 15 of her 2011 Form 1040. And then the next year, 2012, she should report the final $5,000 on line 15 for 2012. But wait. In 2011, Jenny took a distribution of $3,000 from her Roth account and received another Form 1099-R. For 2011, Jenny must report and pay tax on 1/2 of her Roth conversion from 2010 and all of her distribution from 2011. So what was the distribution in 2011? $3,000. What was the amount to include in the income for 2011? $5,000. 5 plus 3 equals 8. So let's see how that turns out. So we're looking at Part 3 of page 2 of Jenny's 2011 8606. And you can see we're reporting the distribution on line 19. We're showing a basis amount on line 24 of $10,000, but technically she doesn't really have basis in it yet because none of it's been reported in income yet. So the form asks you to report how much of a basis you have in your Roth account, but then it also asks how much of that basis came from years before 2010. And in this case, none of it came from before 2010. Ultimately, by the time you're done, the form has you add up the 3 and the 5 and gives you 8. And then it says enter 8 on Form 1040, line 15B. And then you'll see the final line, line 38, says this is the amount that's subject to income tax in 2012. So Jenny doesn't get to pull out 3 in 2011 and claim it's part of the 5 that she's reporting in 2011. She's going to have to take the 3 and add it to the 5, and it's being subtracted out of the amount she would have reported for 2012. So here is Jenny's Form 1040. We're just looking at the income section of her 2011 Form 1040, and here's what it looks like. On line 15A, she's reporting gross distributions received in 2011 of $3,000, but a taxable amount on line 15B of $8,000. We're used to seeing 15B less than 15A, not more than 15A. But for 2011 and 2012, we'll be seeing situations where 15B can be higher than 15A. Now please note that if the only Roth IRA income that you are reporting in 2011 is the 50% amount from the 2010 conversion, no Form 8606 is required. You can just enter the income directly on the line. So let's suppose then that Jenny had not taken a distribution from her Roth account in 2011. If she had not taken a distribution from her Roth account in 2011, then the amount on line 15A would be 0, and the amount on line 15B would be $5,000, and Form 8606 would not be attached to the return. It's just be a direct entry. Line 16. This also has to do with the Roth IRA rollovers, but in this case, line 16 is used to show distributions from pension plans and annuities. Line 15 is used to report distributions from IRAs, SEPs, and simple plans, and line 16 is used to report distributions from other types of retirement plans. So if you had a distribution from a 401k plan that you rolled into a Roth IRA in 2010, then that rollover amount, the 50% amount that you have to report in 11 and in 12, is going to go on line 16 rather than line 15. There's also some information in here about designated Roth accounts. A designated Roth account is a separate account inside of a 401k, 403b, or other government type plan that holds designated Roth contributions. So it's very different. It's not a kind of IRA. Even though it's called Roth, it's not the same thing as a Roth IRA. And there's some special rules about doing those types of in-plan rollovers. So if you did an in-plan rollover from a 401k to a Roth IRA, you were also allowed to defer the reporting of the income, but only if it happened after a specified date in 2010, which was September 27th. And that rule that allows those rollovers from retirement accounts into in-plan Roths or to external Roths continues to be in effect. This is a pretty big change because for the whole history of Roth IRAs, well, in the early days, the only way you could put money into a Roth was as a cash contribution or as a rollover from a traditional IRA. And over time, the rules have loosened to allow rollovers from regular types of retirement accounts. And then in 2010, the limit on income was removed so that regardless of your income level and regardless of your filing status, you can do these conversions. So previously it was the case, let's say you're a high-income wage earner and you're earning $150,000 a year and you have a bunch of money in your 401k and you want to roll it into a Roth account, you would not have been allowed to do so because you earn too much. Well, beginning in 2010, the income limits are thrown out. And anybody, regardless of their income level, can do those conversions. So the 1099-R has had some minor changes made to it for 2011. That's the reporting document just up here. Let me get back to it. Jenny's 1099-R. So here is her 1099-R. This document has been slightly changed for 2011. You can see in 2010 there's a blank box here and there's a box with a description in it but no number. Those boxes have been adjusted somewhat for 2011 and later years. Box 10 on the new 2011 1099-R shows the amount that is allocable to an in-plan Roth rollover within 5 years. It shows the amount of any distribution that is allocable to an in-plan Roth rollover if it is made within 5 years, beginning with the year of the distribution or the year of the rollover. Also, box 11, this was the first year of opening a designated Roth account, and box B, or code B, box 7, is a new distribution code. So box 7 is how you identify the type of distribution going on and what the tax treatment for that distribution will be. Most 1099-Rs are issued with a distribution code of either 7 or 1. 7 means it's a normal distribution, normal income from a person who's simply retired and is taking distributions from a retirement account. And of course, code 1 means it's an early distribution where the person was too young to take the money out and they're going to be punished by paying extra tax. And there's a bunch of other codes that are less common than those two, including code G, which means there was a rollover, right? Well, there's now a new code, and that's code B. And this is a new distribution code which is used to report a designated Roth account distribution. And here, of course, is the new 1099-R. Other changes that were in play for 2011 was a continuation of a special rule from 2010, which had to do with qualified charitable distributions. A QCD is a non-taxable distribution from an IRA of an individual age 70 and a half or older, other than SEP or simple IRAs, of up to $100,000, which is made directly by the trustee of the IRA to organizations eligible to receive tax-deductible contributions. So what happens is when you reach age 70 and a half, and it's actually April 1st of the year following the year you turn age 70 and a half, you have to start taking mandatory minimum distributions from your IRA. And if you do not, whatever that minimum distribution should have been for the year, the IRS will take half of it in tax as a penalty. It's a 50% penalty on the minimum distribution. Well, there is a temporary rule in place for both 2010 and 2011 that allows a person who is required to take minimum distributions to have that money come directly from the IRA account to a qualifying nonprofit. And it will be treated as a distribution in terms of meeting the minimum required amount that has to be distributed, but it won't be taxable because it went to a nonprofit. So that was a rule that was supposed to expire at the end of 2010, and it was reinstated to go all the way through 2011. And also, if you did take a distribution as a qualifying charitable distribution in 2011, but you did so in the month of January, you could treat it as if it had occurred in 2010. But that election was made on the 2010 return. All right, so moving on to the next line, we're past the income lines now, and we're moving on to the educator expense line. That's where we claim an adjustment to income for educator expenses. And educator expenses, that particular deduction of $250 per teacher was set to expire at the end of 2009. But on December 17th, 2010, legislation was passed that carries that particular deduction through 2011. As of 2012, it's no longer on the books. It's not a deduction that will be allowed on 2012 returns, but it is a deduction allowed on 2011 returns. The deduction is a maximum of $250 per teacher per year that is used to pay for books, supplies, computer equipment, and other classroom materials used by the educator in the classroom. And for the next line we're looking at, the moving expense line, there's been an adjustment upwards in the standard mileage rate allowed for moving expenses. And we're into one of those split years. They are so annoying, where the IRS gives us one mileage rate for the first half of the year and another mileage rate for the second half of the year. And of course, it's bad enough trying to get our customers to tell us how many miles they drove during the year, let alone now how many they drove in the first half and how many they drove in the second half. But it's one of those years where we're going to have them break it down. So we have 19 cents per mile January through June, and 23.5 cents per mile July through December that you can claim as a moving expense. Form 1040, line 29, just as a reminder, the self-employed person may be able to deduct the amount paid for health insurance for himself, his spouse, and his dependents. And under new laws passed under the Health Care Act in 2010, the insurance can also cover his or her child who was under age 17 at the end of 2011, even if that child is not his or her dependent. My understanding is this has been one of the single largest increases in the number of insured people. I mean, that when this rule came into play and parents were allowed to begin claiming or putting their children on their health insurance, that the number of insured people rose dramatically. So it's been very beneficial in terms of getting more people covered. But from the tax side of things, it would be line under age 27, which means they need to be age 26 or less. Okay. So in terms of on the tax return, what does that mean? If you are self-employed and you are claiming a self-employed health insurance deduction, you can claim a deduction for health insurance that you pay for yourself and your family and your child, even if your child is not your dependent, as long as that child's under age 27. Next up, we have deductible IRA contributions. The due date for contributions for your 2011 return is going to be April 17, 2012. Now, April 15th falls on a weekend. April 16th is a Monday, and April 16th is Emancipation Day in Washington, D.C., which means that the entire country is shut down for a day because of Emancipation Day in Washington, D.C. This is not unusual. It's been my observation now that April 15th is no longer the filing deadline. It's the day after Emancipation Day is usually the filing deadline, and that's April 17th. So you have until April 17th to file your return. You also have until April 17th to get money into an IRA and claim a deduction for it on your 2011 tax return. Now, of course, bearing in mind there are rules about making contributions to IRAs, and those rules are largely based upon having income. The income must be compensation. Compensation comes from earnings, such as a job or self-employment, and from alimony. Those are the two forms of compensation that qualify you for making contributions to an IRA. The second part, or the second side of making contributions to an IRA is whether or not you are allowed to claim a deduction because you put money into your traditional IRA. And these rules are income-based if you have a pension plan at work. If you do not have a pension plan at work and you are not married, there is no limit on the amount of income you can make and still be able to claim a deduction for what you put into your IRA. So let's suppose I'm self-employed and I earn $500,000 for the year. I do not have any kind of other pension plan set up for myself, and I am not married. I can put my $5,000 into my IRA and claim a deduction for it. It doesn't matter how much I earned, other than that I earned at least as much as I put in, right? But let's change the scenario a little bit and say I have a pension plan at work, and now I'm earning $500,000. Can I still claim an IRA deduction? And the answer is no. Now I earn too much. Because I have a pension plan at work, I have to be concerned with how much money I'm earning. And if I earn too much, I'm not allowed to claim a deduction. I'm still allowed to put the money in. I'm just not allowed to deduct it. So what is that threshold? Well, for 2011, if you were covered by a retirement plan at work, your deduction for your contribution is limited and phased out based on the incomes you'll see here, but also on this table. And this table is a little bit easier to read from, so I stuck it in. It's right out of Pub 17. If your modified adjusted gross income is $56,000 or less, your deduction is not limited, except by the fact you're not allowed to put in more than $5,000, or if you're age 50 or older, more than $6,000. So technically you could deduct that much money as long as you earned that much money from compensation. If your income is between $56,000 and $66,000, you're allowed a partial deduction, and as soon as you have $66,000 or more of income, there's no deduction allowed at all. For married filing joint, if you have a pension plan at your job and you are filing a joint return, then your deduction is allowed in full as long as your joint return has modified adjusted gross income of $90,000 or less. If the income is between 90 and 110, you are in a phase out, and when the income hits 110,000 or more, you are not allowed a deduction at all. If you are married filing separately, your deduction phases out between $10,000 and $0. The other table to show you is what happens when you are not covered by a pension plan at work, but you have a spouse who is. And for single people who do not have a pension plan at work, you'll see here that you can earn any amount of money and you're allowed a full deduction. But if you are not covered by a pension plan at work, but your spouse is, then you look at the joint return and the joint income on that return. And if that income is less than $169,000, you are allowed a full deduction. If the income is between $169,000 and $179,000, you are allowed a partial deduction. And when the income hits $179,000, you are not allowed a deduction at all. The maximum deduction you are allowed to claim is based on your age. And the age, if you are under age 50, it's a $5,000 deduction. And if you are age 50 or older, it's $6,000. All right, Roth IRA contribution limits. These are very different. So when you're talking with a client and saying, hey, you know, you have until April 17th to go put money in your plan, the conversation that might be going on is, well, do I get a tax break if I do? And the answer is, well, it depends on if you have a pension plan at work and how much you made. If you don't have a pension plan at work, sure, you can save money by putting money in, and I'll tell you how much you're going to save. Let's stick the deduction in here and see how much your tax goes down by. And they might use that information to say, hey, I'm going to go do that because it's going to lower the amount of tax I have. In fact, it might make my refund big enough that I'll just use the refund to make the deposit. Because you can file claiming you made a contribution before you make the contribution, as long as you make the contribution by April 17th. The flip side, or an additional side to that, is some people also qualify for the retirement savings contribution credit, and there might be two tax benefits associated with making a contribution that could be claimed on the return. In any event, that's one option, the traditional IRA. The other option is a Roth IRA. Now, if you have a pension plan at work and you earn too much money, there's no tax incentive to putting the money into a traditional IRA. That is when it makes sense to go put the money in a Roth IRA. Not allowed a deduction? Well, I may as well stick it in a Roth IRA. That's an excellent reason to put it in a Roth. But there are still income issues that you have to be concerned about with Roth. If your filing status is married filing jointly and your modified adjusted gross income is at least $169,000, you're going to be entering into a phase-out. If your income is less than $169,000, you can put a full contribution into your Roth account. And by the way, the Roth rule does not care whether or not you have a pension plan at work. It's not looking at that. It's only looking at the income, and the question on the Roth is, am I allowed to put money in at all? Remember, I told you on a traditional IRA, it doesn't matter how much you earn, you're allowed to put money in. It's a question of whether or not you're allowed to deduct it. But with a Roth, you're concerned about income because if you earn too much, you're not allowed to put money in. So the phase out for married filing joint is 169 to 179. And for single and head of household, the phase out is 107 to 122. And for married filing separately, if you lived with your spouse at any time during the year, your phase out is between $0 and $10,000. But if you did not live with your spouse at any time during the year, the phase out is the same as for single. Now, I find it very interesting, personally, that the government has decided that there's no income restrictions on rollovers from pension plans or traditional IRAs to Roth IRAs, but they still have a limit on making contributions to IRAs. Because obviously all you need to do to get around that rule would be to contribute to the traditional and then roll it over. But anyway, I'm not sure what they plan on doing about that for the future, but obviously if a person wants to make the Roth contribution and they earn too much, you could tell them, well, put it in traditional and then roll it over. Not allowed to claim the deduction, therefore you'll have a basis. If you have a basis, it's not going to cost you anything to roll over. See what I'm saying? Okay. But back again, this AGI limitation on conversions to Roths is eliminated, which is therefore where my story comes from. Okay, Form 1040, line 33. The above-the-line deduction for student loan interest expense was set to expire at the end of 2010. However, the Reed-McConnell Act has extended it all the way through 2012. So remember the educator expense? 2011 is the last year. For the student loan interest deduction, the last year is 2012. And the deduction is a maximum of $2,500 for tax years 2010 through 2012. There's a phase-out on your ability to claim a deduction for student loan interest. That phase-out happens when you are single and your income is between $60,000 and $75,000, or take that amount and double it if you're filing a joint return. The tuition and fees deduction, that was set to expire at the end of 2009. But it was extended through 2010 and 11, which means 11 is the last year for the tuition and fees deduction. Beyond the fact that it's expiring at the end of 2011, we also have the phase-outs where we have to factor those in. And the phase-outs for the tuition and fees deduction used to be higher than the phase-outs for the education credits. And so we often had people that earned too much to qualify for the lifetime learning credit or the HOPE credit, as it was called back then. So what was left was the tuition and fees deduction, and that was better than nothing. But the American Opportunity Credit actually has a higher phase-out than the tuition and fees deduction. So if a person qualifies for the American Opportunity Credit, they're better off claiming that. But the lifetime learning credit now has a lower limit, and somewhere between American Opportunity Credit limit and the lifetime learning credit limit, you have the tuition and fees deduction limit. And the limit on the tuition and fees deduction is a maximum deduction of $4,000 or a maximum deduction of $2,000 or a deduction of 0. And if your income is $65,000 or less, the deduction is limited to $4,000. If your income is $65,001 or more, but not more than $80,000, then the deduction is $2,000. And if your income is $80,001 or higher, the deduction is 0. And of course, you can take those phase-outs and double them on married filing joint returns. Standard deductions have gone up. We're on to line 40. So we flipped over to page 2 of our 1040 now, and we're looking at the standard deduction. Standard deductions have gone up across the board, and that was after being set in stone for 2010. 2010 was the same for every filing status except head of household. It was the only one that had an increase. So for 2011, we're seeing higher standard deductions across the board, including the additional standard deduction if you were blind or age 65 and a half or older. That has increased by $50. What's changed in the world of itemized deductions? Well, the phase-out of itemized deductions, since 1991, the amount of itemized deduction you are allowed to claim has been reduced if your income goes above a certain amount. And back in 2009, that number was $166,800. So if your adjusted gross income was higher than $166,800, your itemized deductions went down. And as much as 80% of them could disappear. Well, that phase-out was eliminated for 1 year. But that 1 year has been expanded to 3 years because of legislation passed at the end of 2010. So for tax years 2009, 2010, 2011, and 12, there's no phase-out on your itemized deductions. You're allowed them in full, but don't worry about that, because if you're worrying about that phase-out, alternative minimum tax will take care of it. So anything you save on this line, AMT will take away from you on the next line. It's just a tip. All right, Schedule A, line 1, medical and dental expenses. The mileage rate that you are allowed to claim is also split up the middle of the year. 19 cents per mile for the first half of the year, 23.5 cents per mile for the second half of the year. On to line 5B of Schedule A, that's where you claim a deduction for general sales tax. That particular deduction came into play with the Bush tax cuts beginning way back in 2001, and it was set to expire at the end of 2009. However, the deduction for sales tax has been extended through 2010 and 2011, so it's still allowed on 2011 returns, but presumably will be gone for 2012. Schedule A, line 6, 10, and 13. This is kind of a weird one. I just found out about this by reading enough places about what was new for the year, and I came across something called, a weird new document, you'll see it right here, a 1098 MA. Now this is something that could be brought into, I would expect it's going to be a document issued mainly to lower income filers, but I could see some moderate income filers could be getting them as well. Because what it has to do with is this government assistance to help people make mortgage payments. So if you've been in a hard-hit area and you lost your job and you couldn't make mortgage payments on a house that's dropped in value and is probably worth less than what you paid for it and so forth, it may be that you qualify for these emergency aid programs that will step in and make some of your mortgage payments for you. And if you're an individual who benefited under those programs, it stands to reason that you personally will not be allowed to claim a deduction for a payment that was made by a state agency, right? So this document is being issued to show whether or not a filer had mortgage payments made for them during the year, and if so, how much of those payments went towards property taxes and mortgage interest. And it stands to reason that you're going to be allowed to claim only a deduction for the payments that you yourself made. So this document is showing payments that the homeowner made in box 3, and it's showing other amounts that were paid out in boxes 1 and 2. And the IRS is providing a safe harbor method to figure out what your client's deduction will actually be on the tax return. And they say take the amount in box 3, and pretty much you can probably use that, but don't use more than the amounts showing on the 1098. So the 1098 could still come out, and the 1098 is showing the amount of mortgage interest that was paid on your home for the year, But if this government agency made the payments for you, you shouldn't be normally claiming more than is in box 3 of the 1098-MA unless there's some other mortgage that you were making payments on, or unless the math is wrong. So you can take that home and mull over it a little. Schedule A, line 13, that is where you claim a deduction for mortgage insurance premiums. Under current law, a taxpayer can claim an itemized deduction for the cost of mortgage insurance on a qualified personal residence. This also was set to expire at the end of 2010. However, it has been extended through 2011, which means that after 2011, the mortgage insurance deduction may have disappeared. But we are allowed to claim it for this year. Schedule A, line 16, charity. Volunteer standard mileage rate has not changed. It's still 14 cents a mile, and there's no mid-year adjustment to worry about. Schedule A, line 21, employee business expenses. The standard mileage rate that you can claim for employee business expenses, and this is the one we most commonly use because we use it on Form 2106 and also on Schedule C. It's 51 cents per mile the first half of the year and 55.5 cents per mile the second half of the year. Form 1040, line 42, this is where we claim our exemption deduction, and that also was not changed for 2 years. We had the same number for 2 years, but it did go up. 2011, the amount is now $3,700. Also, remember that EGTRA Act? It had removed the phase-out of the exemption deduction for tax years 2009 and 2010. Well, that also has been extended through 2012. So there's no phase-out on the deduction, the itemized deductions, and there is no phase-out on personal exemptions for 2011. But as I already said, AMT will pick up and take it away anyway. I really don't understand the purpose of that no phase-out because AMT taxes exactly the income that these don't give you a break on. Anyway. Line 44, we have our new tax tables up for the year. These are just the tax rates charts, and they're based on income. Clients often ask, what tax bracket am I in? And this is where you can go to tell them, well, you're in the 10% bracket or you're in the 25% bracket. But bear in mind that the numbers shown here for income are taxable income, not gross income. So you take your adjusted gross income, you subtract out your itemized deductions or your standard deduction, you subtract out your personal and dependency exemptions, and you get a number which is your taxable income. If that number exceeds the numbers on this form, that's when you move into the next tax bracket. You can see that the minimum bracket is 10%, the maximum bracket is 35%, and those brackets were supposed to go up in 2011, but they did not, and they're temporarily still set at those amounts. But after 2012, those brackets are supposed to go up. The 10% bracket will disappear and be replaced with the 15% bracket, and then we will also have 28, 33, and 35% brackets that are going to be replaced with higher brackets that go as high as 39.6%. So I think it's going to be an interesting year at our federal government as Congress and our President argue about what's going to pass for tax measures, because all of these tax breaks that were extended at the end of 2010 expire in 2012, and unless our government does nothing about it, taxes will go up dramatically in 2013. So if our government does nothing at all, we'll be back to the days we had when we had Clinton as president. So the tax structure that existed under Clinton will essentially, in large part, return, unless our government does something in 2012. So it will be interesting. There's a question in the classroom, is that a good or a bad thing? Well, that would depend on your political viewpoint. I personally thought the tax cuts were a bad idea because they'd put us into a, what is the word, deficit? I guess I was right, but I'm sure, you know, half the population could have figured that one out. So I'll stay out of that one. All right, on to one other point. One of the things that also happened under Bush, and actually even starting before Bush, when we had Republicans in office, or not in office, but controlling the House. If you remember the days when Newt Gingrich was in control of the House, that was when they launched on reducing capital gain rates. So we're talking in the late 90s. that capital gain rates were reduced. And I personally can remember a time when capital gain rates were 28%. And today we're sitting at 15 and even 0, depending on the tax bracket that you're in. And those reduced rates are going to continue to play through 2012, but unless something changes, in 2013 they're going to go up. 28% would be the minimum, I believe. Or is it 20? Anyway, there's going to be, yeah, 20. Thank you. But even so, even with the existing 0 and 15% capital gain rates, there are other exceptional capital gain rates that are applied in situations where the lower rates are not allowed. And those include when you sell collectibles at a gain. The maximum capital gain rate on collectibles is 28% and always has been 28%. Also, the gain that you pay tax on a Section 1202 exclusion, the amount that's not excluded is subject to a 28% rate. Remember I told you about my Wizards of the Coast client? He sold his stock and he had a huge gain and he only had to pay tax on half the gain. Well, the rule is that the half of the gain that's taxed isn't taxed at 0 or 15%, it's taxed at 28%. So in effect, you get an overall rate of 14%, right? So that's what that one's about. Then we have unrecaptured Section 1250 gain. That happens when you recover depreciation on the sale of real estate. That's 25%. And of course, then we have the 15 and the 0% brackets. Alternative minimum tax. Lots of people talk about the alternative minimum tax in the news, and the government is very much aware of the problems created by alternative minimum tax, but the average taxpayer has absolutely no idea what it is or how it works. But to give it to you in a nutshell, when you file your tax return under the regular tax, you get your standard deduction or your itemized deductions, and you get to claim your dependents, and then you figure your tax and you start subtracting out credits. Under alternative minimum tax, you get your itemized deductions, except for the part of those itemized deductions that's for taxes. So you don't get to deduct income taxes, you don't get to deduct property taxes under AMT. The deductions that you're allowed there, including dependency deductions, are replaced with an exemption deduction instead. So what this is saying is if you're single and your income is less than $50,000, you're never going to have to worry about AMT. Not going to have to. For 2011, because they raised that exemption amount to $48,000 for 2011, but without that patch, the exemption deduction would only be $33,000, which means technically speaking that a person earning $50,000 a year could be paying AMT, but we have a patch, so we're not. And that patch has only been in place or put in place through 2011, so there's going to be another big fight in our government in 2012 about raising the exemption. So the 2011 filing season was delayed over last-minute legislation, including patches to the alternative minimum tax. The 2010 tax season was delayed over last-minute changes to the exemption amount of the AMT for 2010, and I predict we're going to have a last-minute fight in December of 2012, but we'll see. So with no changes, huge percentages of the population will be paying AMT in 2013 unless something happens. $48,000 is the exemption amount, and what that says is it's not that simple a formula, but you figure your income and you figure your tax under the regular code, and then you refigure your income under the alternative minimum tax, and the deduction most people are allowed to claim under AMT is the exemption deduction you see here. And if your income is greater than the amount here, then you technically could be paying tax under AMT. It's a much more complicated formula than that, and of course I have an entire 4-hour course that does nothing more than explain it to you. But for today I'm going to move on. Education credits. This is a huge one. I could not believe my ears. I went to an IRS update forum in November and it was like, are you kidding me? They said it there, and then it was also, I watched one of the videos or read the transcript from the IRS National Forums. Apparently there was an error on the 1098 document, the 1098T, in the description for what to do if the graduate box was checked. And the instructions say that if the graduate box is checked, you are not eligible for the American Opportunity Credit. And that was, of course, the rule for the HOPE credit. So we're used to that. As tax professionals, we know, oh, you're not allowed the HOPE credit because, well, you're a graduate student. You already have your 4-year degree, and the HOPE credit is only for people enrolled in their first 4-year degree program. And the American Opportunity Credit appeared to have all of the same rules, except it was more generous. But wait, the IRS has determined that graduate students are eligible for the American Opportunity Credit. Prior year instructions on 1098-T and the 8863 stated that if the graduate student box was checked on the Form 1098-T, then the student was not eligible for the credit. This change is significant because taxpayers who were told they could not claim the American Opportunity Credit for tax years 2009 and 2010 because they were enrolled in a graduate degree program should now go back and amend the returns and claim it. Now get this, the IRS person who was speaking said, well, this is only going to be a problem for the people who read the instructions. So if you didn't know what you were doing and you took the credit, good for you. But if you knew what you were doing, like me, and you read the instructions, you got it wrong. So part of the interview process, I would say, for 2011 tax returns would be to be screening the clients. Were they in a graduate program in either of the 2 earlier years, and did you tell them or did their preparer tell them they could not claim the credit? Because if that happened, we want to go back and amend those. And of course, we know now to claim them on 2011 returns. Now, here is the IRS's table on the rules for claiming the American Opportunity Credit and the Lifetime Learning Credit. And the limit on income. So I was showing you or explaining to you earlier under adjustments to income that the phase out for the tuition and fees deduction happens at an income level that is between the phase out ranges for the Lifetime Learning Credit and the American Opportunity Credit. So if you qualify for the American Opportunity Credit, awesome, because it's the best credit, it has the highest phase out, it gives you the best deal. If you don't qualify for the American Opportunity Credit, and the reason you would not qualify is you're not at least a half-time student. You have to be enrolled in a degree program, and you have to be at least a half-time student, and you can't have a felony drug conviction. So those are the rules for the American Opportunity Credit, and if you meet them, you get it. But if you fail to meet one of those conditions, then you move over to the Lifetime Learning Credit, and what's going to happen to you there is you might earn too much, because you can see that the phase out on it is $122,000 for married filing joint compared to $180,000 for the American Opportunity Credit. So if you're too high in income for the Lifetime Learning Credit and you don't qualify for the American Opportunity Credit, move over and see if you can claim the tuition and fees deduction. And in certain situations, even if you qualify for the Lifetime Learning Credit, you may still be better off with the tuition and fees deduction, because if you're in a higher bracket, say 25%, 25% of $4,000 is better than 20% of $4,000, because the Lifetime Learning Credit is 20% of the qualifying expense. So you I play the numbers every different way and figure out which one is best for my clients and go with it. Some tax software packages kind of do those computations for you and make a recommendation or a selection on the credit for you. I personally don't have software that does that for me. I have to understand the rules and think through it. Okay. Form 1040, line 52, we're on to the residential energy credit. Form 5695 is used to claim 2 different kinds of residential energy credit. Part 1 is the non-business energy property credit, and Part 2 is the residential energy efficient property credit. You can rely on a manufacturer's certification that whatever it is they're selling you qualifies for the credit, does in fact qualify for the credit. So if they tell you, you buy this appliance, it's going to give you an energy credit, like a new furnace or something, you can believe them. You're allowed to do that. But there is a basis reduction. You must reduce the basis of your home by the amount of any credit that you claim. How do you claim the credit? Well, you complete Form 5695 and attach it to your tax return. Well, this credit's kind of bounced all over the place. We had no credit at all in 2006. Then in 2007 and 2008, we had a $500 credit based on 10% of the cost of the improvement. We had no credit at all in 2009, and then for 2011, or 2010 rather, we had a $1,500 credit based on 30% of the cost of the improvement. And now for 2011, we're back down to $500 for 10% of the cost of the improvement. But wait, this is a lifetime cap of $500. So what that means is if your client claimed an energy credit in any of the earlier years, whatever amount of credit they claimed in the earlier years is subtracted from this year's credit. So if your client claimed a $1,500 energy credit last year, they're out. If they claimed a $300 energy credit last year, they have $200 left for this year. And if they claimed $200 in 2007 and $200 in 2008, they have $100 left for this year. Got it? The form has lines to help you figure all that out. Now, in addition to the $500 lifetime cap, there are other caps you have to be concerned with. And those caps are that the maximum credit allowed in your lifetime for the cost of windows is $200, $50 for any advanced main air circulating fan, $150 for any qualified natural gas, propane, or oil furnace or hot water boiler, and $300 for any item of energy efficient building property. Qualified energy efficiency improvements are different from these. If you look at the form, there's two different categories. And one is for things like windows and insulation, and the other is for things like furnaces. So windows, insulation, new roofing that has heat reflective coatings on it and so forth, those amounts, the credit is based on 10% of the cost of those improvements, not including labor. So if you were to insulate your house and it cost you $3,000 to insulate your house, the majority of that cost is probably the labor involved with putting the insulation in. And you're not allowed a credit for any portion of the cost of the labor, only the actual cost of the insulation itself, which is actually not a big number. So when you're dealing with any of these items, insulation, windows, exterior doors, or new roof on your house, you get the cost of the item only, not any cost associated with installing it. But there are other items that you are allowed the cost of labor on. And the breakout is done for you on the Form 5695. So I've just got that up in front of you, and I've drawn circles around the portions that you should be paying attention to. Firstly, line 2 says, how much of a credit did you claim on each of these earlier years? Add it up and put it on line 2C. Then it says, what is the amount that you made for these certain types of energy efficiency improvements, which again are doors, windows, and roofing and insulation, and total those up. And don't add or include any labor in there. Then separately, farther down the page on line 6, it asks for other kinds of energy efficiency improvements to your home, including things like furnaces, where you are allowed to claim the cost of labor. So think about it. The cost of installing a furnace, part of the cost is going to be the cost of the furnace, and part of the cost is going to be the cost of labor, and the credit is allowed on that entire cost. But it's 10% of the cost, not to exceed $300 of credit. So if your furnace, including installation, costs you $3,000, you're not much going to be affected. Well, actually, you would be affected by the limit because the limit is $150. I have a student in the classroom saying, I'm going to charge him that much for the form. What's the point? Okay. Anyway, just wanted you to be aware of these limits and how they can be impacted by earlier years, but you may still have clients coming in who did an energy efficiency improvement and they were told by the salesman that they get this credit and they're bringing all this paperwork in. And there's all kinds of rules that you have to kind of rattle through in your brain to figure out what you're going to get. Moving on, the residential energy credit form has a side 2. And side 2 is much more generous than side 1. And when we talk about these temporary energy efficiency credits that are in place, we're talking only about energy credits for page 1. There are other energy credits available on page 2 that are not subject to any of those limits, and they're also not set to expire. So 2011, we're allowed this $500 credit. In 2012, there's nothing there waiting for us in the energy credit world on page 1. But page 2 will still be there for us next year. And page 2 is very interesting because let's see what's on page 2. Solar electricity property, solar water heating property, small wind energy property, geothermal heat pump property, and fuel cell property. So if you have clients who are making any kinds of these types of energy efficiency improvements to their homes, these will continue to qualify for credits, and they will not be limited to that $500 amount. They've got whole separate rules that apply to them. Other credits. Car credits. I think this is going to be one of the big credits in the coming years, these new plug-in cars. Now, I'm in Portland, Oregon, as are all the people in my classroom, and Portland is one of the test centers for the new Nissan Leaf. And so there's a number of manufacturers that focus on Portland because we're a city that kind of likes electric stuff like this. So we're seeing a few of them driving around already. Have any of you seen a Nissan Leaf driving around? I've been seeing them. And there's been talk on the news about the new Chevy Volt. There's two sides to it. The people who buy them love them. They've got a very high owner satisfaction rate. Do you have one? No. Oh, you want one? Okay. On the other side, the crash tests have shown that there's been fires that have been started on the cars in the battery compartments. So GM is busy fussing with the crash test side of our government about making sure that the car is protected and there won't be a fire in the event of a collision. But on the plus side, people who are buying these Volts love them. And I know I've got my eyes set on them. The Chevy Volt is the only one I'm aware of that is a hybrid plug-in, so it will run on gasoline as well as electricity. A lot of these other cars are electric only. But let's look at the credit itself. The rules for the credit are that it ranges from $2,500 to $7,500 per vehicle. But what I've observed is that every single vehicle that qualifies is actually qualifying at the $7,500 level. And I went online 2 days ago and pulled up all of the current qualifying vehicles, and this is a list of all of the vehicles that have currently been approved for the credit. And you could have had a client that had bought any one of these. All right, moving on. Here is the form that you will fill out if you claim a credit for a qualified plug-in electric drive vehicle. There are other kinds of credits available for electric cars. This other kind of credit I'm coming to is claimed on a different form, 8834, and it's claimed for low-speed four-wheel drive vehicles as well as regular speed two- and three-wheel vehicles. And we've got some pictures of some of the vehicles that qualify for this other kind of credit, and you can see it even includes this little motorcycle. So there are essentially 3 different credits available for the purchase of vehicles this year, and your client may qualify for any of them or none of them. And then finally, the alternative motor vehicle credit, it is largely expired. This is the credit that we were claiming on hybrid cars for the past several years. It expired at the end of 2010 for all vehicles except this one, which happens to be a Honda 2011 or 10 FCX Clarity fuel cell vehicle. If you have a client who bought one of them babies, they get a credit. It happens to be the only fuel cell vehicle out on the road. It happens to be that the credit is gone for hybrids, but it's still there for fuel cell vehicles, and the only fuel cell vehicle approved is this one. Also, the credit continues for people who bought hybrid conversion kits and installed them on their vehicles in 2011. All right, and a final note before we take our break. For purposes of alternative minimum tax, it has been historically the case that if you qualified for an energy credit, AMT would take it away from you if you were subject to AMT. But for 2010 and 2011, that is not the case. So if your client purchased one of these qualifying vehicles last year, AMT will not take the credit away from them. But for 2011 or 2012, they could purchase the car, think they're getting a $7,500 credit, and then find out they don't benefit because they earn too much money. We were in the business of talking about credits, weren't we? And I finished talking about the energy credits and the education credits, and now we're on to the District of Columbia first-time homebuyer credit. Now, those of us sitting here in Portland, Oregon might be saying, why the heck would I ever need to worry about the District of Columbia first-time homebuyer credit? Well, believe it or not, I've done a return for someone who qualified for and claimed it. You can't get much farther away from Washington, D.C. than the West Coast, except maybe Hawaii. But it is, people do buy homes in Washington, D.C., and they can qualify for the credit. Now, the credit was supposed to have expired, but it was reinstated for 2010 and 11. And the restrictions on it are completely different than the restrictions on the other first-time homebuyer credit that we all know more about. But there has been for many, many years, and there continues to be through 2011, a District of Columbia first-time homebuyer credit. The credit is the smaller of $5,000 or the purchase price of the home, which stands to reason there may be arguing a home could cost less than $5,000 in D.C. I'm not quite sure where to go with that other than that to make that conclusion. At any rate, in general, you may claim the credit if you purchased a main home during the tax year in the District of Columbia and you and your spouse, if married, do not own any other home in the District of Columbia during the one-year period ending on that date. So essentially, if for some reason you have to move to Washington, D.C. and you purchase a home there, you could get the credit. And the deal with the credit is it has had historically a carry-forward provision. So even after you move out of the home and leave the state, you may still own the home and be continuing to claim the credit historically. All right, but wait, if you happen to qualify for the first-time homebuyer credit claimed on Form 5405, you may not claim both credits. In fact, you can only claim the one on 5405 and you're not allowed the DC credit. Okay, on to Form 1040, line 56, self-employment tax. For 2010 only, you may remember that we were doing a rather complex calculation to figure how much income we would pay self-employment tax on. And that was because historically it's been the case, you figure what your total income from self-employment is, typically from line 12 of the 1040 form, the amount of profit on your Schedule C. But if you have a K-1 flowing through from a partnership, or if you're a farmer filing Schedule F, you would also have to account for those two types of self-employment income. And you total them out, you fill out Schedule SE, and you figure your self-employment tax. Well, for 2010 only, you were allowed to reduce the amount of income that you paid self-employment tax on by the cost of your health insurance. That was 2010 only. So don't be going around thinking you can do it in 2011, because you can't. So that's my update on the self-employment tax. It's back to the way it always was, and forget 2010 ever happened. All right, moving on to Form 1040, line 58. That is where we calculate the additional tax on IRAs and other qualified retirement plans, etc. Attach Form 5329 if required. We just wanted to remind you that there is a 6% excise tax on excess contributions you have not withdrawn by the due date, including extensions for your tax return. So if you put more money into your retirement account than you are allowed to put in, you need to get it out of there. And if you don't get it out of there, it's a 6% penalty. So you have until the due date of the return to get it out. Form 1040, line 59B. This is a tax line specifically dedicated to repaying the first-time homebuyer credit. Now, we have had 3 different first-time homebuyer credits in a 3-year period, actually within a 2-year period. The first-time homebuyer credit was the 2008 credit, and that credit was a maximum of $7,500, and it amounted to essentially being an interest-free loan of $7,500 that needed to be repaid, or needs to be repaid, over a 15-year period beginning in 2010. So if you have a client who purchased a home in 2008 and claimed the 2008 first-time homebuyer credit, they needed to start entering $500 on line 59B on their 2010 1040, and they will need to continue doing that for the next 15 years or until they sell it, whichever comes first. Now, that's the 2008 credit. We also had the 2009 and technically the 2010 credit too, and well, for some people there's a 2011 credit. And if you purchased the home under the 2009 or 2010 first-time homebuyer credits, that's a maximum credit of $8,000 that does not have to be repaid. It was just like free money being given to you to help you make the down payment on the house, essentially. Now, there were rules for the credit, the first-time homebuyer credit. One of those rules is that you have to buy the home and live in the home as your main home for 3 years. And if you move out of the home within 3 years, you have to repay the entire credit up to the gain or less than the gain if you don't have a gain. So it's possible you don't have to repay the credit if you had no gain, or if your gain was less than $8,000, you don't have to repay it. But if you live in the home for 3 years and then sell it or then move out, you don't ever have to repay the credit. They have some other exceptions to what happens if you move out within 3 years. For example, you die. Well, they don't make dead people repay the credits. That's nice to know. But if you divorce and your spouse gets the house, then the responsibility for repaying the credit or fulfilling the 3-year term goes to the spouse who keeps the house. Someone in the room is looking like, oh, maybe that's me. Okay. Then we move on to what happens if you actually sell the house early. And also, I just wanted to briefly touch on the fact that the first-time homebuyer credit had a supplement to it for 2009, 2010. It was actually passed late in 2009, like in November of 2009, they came out with the third first-time homebuyer credit, which had a long-term resident credit added in. And the first-time homebuyer credit, you couldn't have owned a home for like the last 3 years, and you had to meet all of these restrictions. Then they also had this long-term resident credit, which said if you owned and occupied your home five out of the last 7 years, something along those lines, I don't remember the details now, that you could get a credit of $6,500 if you bought another new home. So that credit is out there as well, called the long-term resident credit. But that's kind of in the history now. I'm not really talking about those credits so much because they're in the past, except for one exclusive group of people I'll talk about a little bit later. For now, we're talking about the repayment of the credit, and that's for people who claimed the credit but moved out of their home sooner than the 3-year period, or if they were claiming the 2008 credit, sell the home within 15 years. So this is something we're going to be dealing with for up to 15 years for people who claim the 2008 credit. So here's an example. We have Johnny sold too soon. He received a $7,500 credit as a 2008 first-time homebuyer. He purchased his home on July 1, 2008 for $250,000. His adjusted basis in the home is $242,500. How do we get that? We take the purchase price and subtract out the credit, and that leaves us with his basis. Johnny repaid $500 of the credit with his 2010 tax return, and then he sold the home on June 30th, 2011 for $253,000. Expenses of the sales totaled $4,500, and his net gain from the sale is figured as follows. So we take his acquisition price, we subtract out the credit that he claimed, and then we add in the credit that he repaid to get his adjusted basis in the home. We then go to the selling price of the home, subtract out the expenses from the sale to get the adjusted basis and the gain on the sale. And we end up with a gain of $5,500, and where do we put that on the tax return? Well, we put it as tax on line 59B right here. So this is Johnny Sold Too Soon's Form 1040, page 2, and on line 59B, we're going to add in $5,500. Now, if he had not sold the home, we would only enter $500 on the line. But because he sold the home, we have to do that calculation. And the form itself provides space to do the calculation. What was the credit you claimed? How much did you repay? Figure your net gain on the home, and then carry that net gain down here and whack it on the line. Form 1040, line 60. Remember at the start of class I told you that the IRS has introduced a new line on the back page of the 1040 to enter all of those other taxes that are out there? I found it quite interesting when I went to create a table of all of those extra taxes, because they had them all in bullet form, and I thought it would be easier to kind of absorb them if they were on a table, so I created a table for you and stuck them all in there. And essentially it says this is the additional tax that a person might be required to pay. This is the code that you need to enter on the line, and if any other type of form is required, this is what it is. Fill it out and attach it. And the first example up at the top is the additional tax on healthcare savings accounts, or HSA distributions. The code for that is HSA, and if you're subject to that tax, or if you made a contribution to the plan, you're going to need to complete Form 8889. And I'm not going to explain any of the other additional taxes to you. I'll leave those for your reading pleasure. But I will go down to talk a little bit more about that additional tax on HSA distributions. And the reason that I'm going to do that is that for HSAs and MSAs, which are medical savings account, the additional tax on distributions not used for qualified medical expenses is increased to 20%. So previously, I think it was only 5%. So what does that mean? All right, I have a medical savings account, and I put $2,000 into that account. I'm allowed to claim a deduction for that on my tax return. Later on, I have medical expenses, so I take the money from the account and I use it to pay those expenses. It's important that the expenses I pay are not less than the money I pull out. If I pull out more money than I have in expenses, I'm going to have to pay tax on the difference, and I'm also going to owe a penalty on the difference. So let's suppose I take $2,000 out of my HSA and I spend $1,000 on medical expenses, and I have $1,000 left over. What's going to happen to me? Well, I'm going to have to report $1,000 of income on my tax return, and I'm going to have to pay a $200 penalty on top of that. It's a 20% penalty. All right. Also, what is a qualified medical expense for purposes of an HSA distribution? So when I take money out and I spend it on quote-unquote medical, what is quote-unquote medical? Well, there are lots of definitions out there for that, and essentially the IRS's definition of a qualifying expense is the same kind of expense that would be allowed as a deduction on Schedule A. Now, there had been kind of a loophole in it that was allowing people to use their HSAs to purchase over-the-counter drugs. And beginning in 2011, that's gone. You can no longer use HSA distributions to purchase over-the-counter drugs unless your doctor gave you a prescription for the over-the-counter drug that does not normally need a prescription. So if you wanted to use your HSA distribution to purchase cough syrup, you would now only be able to use an HSA distribution to pay for that if your doctor gave you a prescription for it. So you get a prescription for NyQuil, for example. It seems kind of silly and red tape-ish to me, but that's the way the rule is now. The only exception to the prescription rule is if you buy insulin. Insulin does not require a prescription, and you are still allowed to use your HSA distributions for purposes of buying insulin. Next line on the 1040 form is the advanced earned income credit line, or rather the lack of it. It's gone. The IRS did an estimate of the number of people out there who qualify for earned income credit who were claiming the advanced earned income credit, and it was only 3% of them. And from my standpoint as a tax practitioner, I hated it because you have to remember to look in box 9 for this advanced EIC, and since 1 in 1,000 W-2s had it, when it was there you just didn't see it, missed it. And then either our error checking department would catch it because they were trained to look for numbers in that box that preparers are always missing, or no one caught it and it made it to IRS, and IRS adjusted the tax return for the client and told the client they owed money that we didn't tell them they owed, or that the refund had shrunk, that type of thing. Well, it's gone. There's no more advanced EIC. So what that means is that those people who qualified for earned income credit and were eligible to receive up to 1/3 of it in advance throughout the year as an addition to their paycheck no longer get that benefit paid in their paycheck. Now they get it all at once as a lump amount at the end of the year. And I think the reason only 3% of filers who qualified for it took it is they didn't like how it made their refunds go down. And it may seem nonsensical, why wouldn't you want it as you go throughout the year, then you have it to live on? But my experience with my earned income credit clients is they like that big check at the end of the year, and they don't want anything making it smaller. All right, Form 1040 payments. This is the section of the Form 1040 where you list refundable credits, estimated tax payments, tax withholdings on 1099s and W-2s. This section is slightly different than it was a year ago, mainly because the Making Work Pay Credit line has disappeared. It's gone. Now, this is going to be somewhat of an explaining story for our clients throughout the tax year. Presumably, withholdings have gone up. Presumably, but there's some people who will notice a big difference on this year's tax return. So let me explain that. The Making Work Pay credit was a refundable credit, so it was treated as withholding. Therefore, if you have a lower income individual who basically was going exempt from withholding on their W-2s, and maybe they earned $15,000 for the year and had zero withholding in their federal tax withholding box, it didn't matter whether they had withholding or not because they didn't need to pay tax. In fact, they'd probably be getting an additional child tax credit. They're going to get the earned income credit. And now on top of it, they were also getting this making work pay credit that gave them a $400 bump if they were single, or an $800 bump if they were married. Well, that bump is gone. So those lower income people are probably going to be squawking this year, because if last year their refund check was $7,000, this year they're going to notice that it's $6,600. They're going to be asking you why. So you may as well be ready to explain it ahead of time. Oh, that making work pay credit is gone. It's going to be a minimum of $400 less than a year ago before I see anything. Okay? That's the first thing you can set them up for. The second part of it is, though, that people who were actually, middle income wage earners who were paying into the system and owing tax each year and paying it through withholding or paying it at the end when they filed, they were seeing some benefit from the making work pay credit throughout the year, because the way the making work pay credit was designed was to reduce paycheck withholding throughout the year and adjust for that with the making work pay credit at the end. So your average middle income working individual throughout the year might earn $50,000 and have X amount of withholding. Well, that X amount of withholding was reduced by $400, and it was made up for at the end of the year by giving the offsetting credit. So the theory behind it was that in the Bush years, Bush sent people checks in the mail. This refund check came in the mail in like November, some weird month of the year, or September. It was spaced throughout the year depending on where your Social Security number was. Do you remember those days? Okay, and the theory behind it was people would get this money and they'd run out and spend it. And what the government found when it did studies was that they were using the refunds to pay off debt, or they were putting it in their savings account and they weren't spending it. And the idea was to stimulate the economy by giving people money to spend, except they weren't doing that. So under Obama, it was decided that the making work pay credit would be given in small increments with each paycheck throughout the year, so people kind of just didn't notice the extra $3 a week and spent it, because that was ultimately what it amounted to, like $6, $7 a week, something like that. But at any rate, the impact on the tax return at the end of the year is that for our lower income clients, they're definitely going to notice a decrease. For our middle income clients and our higher income clients, I don't think that they're going to notice a difference, because presumably when the making work pay credit went away, the federal tax withholding went up. Now, I'm not done talking. The rest of my story is that the making work pay credit has been replaced by the payroll tax deduction or reduction. So remember we said that the self-employment tax has dropped by 2% and the employee's share of Social Security withholding has dropped by the same 2%. The making work pay credit has been offset by that payroll tax reduction. So when the making work pay credit went away, W-2s should presumably have had a bump up in Box 2 federal withholding and a decrease in, I guess it would be Box 5 or Box 4 Social Security withholding. So Social Security withholding should be less and federal income tax withholding should be more, and when they come to the table to prepare their tax return, again, they don't really see a difference. Now the final close to this story is that the payroll tax reduction benefits everyone, I wouldn't say equally, but high income people are benefiting under the payroll tax reduction that were not able to benefit under the making work pay credit. So the making work pay credit had a phase out, and if you earned more than $75,000 if you were single, or $150,000 if you're married, you didn't get it, gone. Didn't get it. But the payroll tax reduction benefits everyone, even people who are earning wages of $500,000 a year. But the benefit is capped at $108,000 because that's the point where Social Security tax stops. So in any event, I think at our point as tax preparers, where we're going to see the biggest difference is when we're calculating the self-employment tax for our clients. Self-employment tax is really the biggest tax most self-employed people pay. And it will be 2% less than it was a year ago, and that'll be a noticeable difference for them. Oh, my favorite, the earned income credit. No year No yearly update class of mine is ever complete without a discussion of the Earned Income Credit. Now, some of my audience was really engaged today with the discussions about all of the business tax credits out there because that's the market you deal with. And many of my audience was falling asleep while I was talking about those credits because they don't have any clients that deal with those. Well, things are about to reverse because now I'm moving into the world of the Earned Income Credit where people who do high-end business returns may never see an Earned Income Credit client. But you should still know the rules, and I'll tell you a story. A few years back, I met a CPA, and he commented to me about the Earned Income Credit. He said, yeah, I don't understand those rules at all. When I get one of those returns, which isn't very often, I just hope my tax software got it right. And I go, really? Let me explain a few things to you. So is it possible that you work in a firm that deals only with high-end returns and that you might have an EIC return crawl across your desk once or twice a tax season? The answer is yes, because typically your high-end clients have children or relatives that they might send to you, and then you're left doing their returns, and so this information is very important, particularly given the scrutiny that the IRS is placing on these returns. So the first thing you need to know about the Earned Income Credit is that for all of its history, the EIC was a certain amount if you had no qualifying children, a certain amount if you had one qualifying child, and a certain amount if you had two qualifying children. And if you had more than two qualifying children, the Earned Income Credit was no larger than if you had two. Well, beginning in 2009, the Earned Income Credit went up if you had 3 or more qualifying children. And it was set to be higher only for 2009 and 2010. But the Reed-McConnell Act extended it for 2011 and 2012 as well. So we continue to be in a situation where the Earned Income Credit is higher for 3 children than it is for 2. And the Earned Income Credit is huge. It is up to 45% of the first $12,750 of income. So it's virtually half of their income for the year. So if you got $12,750, that's essentially working close to full-time at the minimum wage for the whole year, depending on what state you're in, right? And at the end of the year, when you come in and file your tax return, you're going to get almost half of what you earned at one time. It's huge. And because it's so huge, there's a very big temptation for fraud. And the fraud is rampant. It's been a subject of political scrutiny as well as scrutiny on the part of the IRS since before 1995. In fact, I can remember when Senator John Glenn, it was his mission to clean this up. So there is a lot of stuff going on over time as the IRS has burrowed in on this. One of the big events took place in 1995 where the IRS just stopped about half of the EIC claims to do reviews. And that was a very big hardship year for anyone in taxes. If you were around back then, it was awful. But since then, they've continued to have in place scrutinizing systems that evaluate whether or not a particular claim for EIC looks suspicious and should be reviewed. And at any time, you could have a client who is selected for review on their Earned Income Credit claim, even if they've never been reviewed for the last 15 years and nothing's changed. And clients consistently believe that the odds every year go down. That I wasn't audited for the last 10 years, so I won't get audited this year. And if I do get audited this year, it's my tax preparer's fault. It doesn't work that way. When your number's up, your number's up. But let's see what we can do as tax preparers to be on top of the rules. You have to know the rules, and the reason you have to know the rules is the law requires that you know the rules. So the law will soon require that you understand a minimum amount of tax law, a minimum enough necessary to pass the registered tax preparer exam that the IRS is holding. But whether you ever pass that exam or not, the IRS says it's your responsibility to know the rules for Earned Income Credit, and if you don't know the rules for Earned Income Credit, we're going to punish you. So there's no escaping knowing the rules. You have to know them, and that's why I beat them into people. So let's start with the rules right here. Among these rules, and we're looking at what happened under the Fostering Connections to Success and Increasing Adoptions Act of 2008. While that act went on to increase the amount of Earned Income Credit, it also imposed additional rules. And many people are still unaware of what these rules are. The first rule is that the qualifying child must be younger than the taxpayer claiming the child. That means if I'm 18 years old and I had a full-time job and I earned all of the money for my small household and I want to claim EIC from my older sister who's going to college and is a full-time student, I'm not allowed to because I am younger than the qualifying person. Also, the qualifying child must not have filed a joint return other than a claim for refund, and the taxpayer other than the parents of a qualifying child is allowed to claim the child, but only if that taxpayer's adjusted gross income is higher than the highest AGI of any parent of the child. So previously, under the old rules, you could have a household with mom, dad, daughter, and grandchild, all living under the same roof, and mom and dad are married and they earn $50,000 for the year, and the daughter is single mom earning $10,000 a year, and there's grandbaby. And under the old rules, daughter would not have been able to claim EIC because mom and dad earn more. So this change was meant to benefit that daughter, to allow her to have earned income credit for her daughter, even though she's living as a dependent with her parents. But the rules also say that the daughter could choose to give that child to the parents, but only if the parents earn more. So the rules change over time, which is one of the reasons why they're so confusing. But as we sit here right now today, I'm going to tell you the rules as they exist today, and they are summarized ever so nicely in this table that is straight out of Pub 17. So let's look at the parts. The table shows Part 1, or Part A, rules for everybody. Part B, rules if you have a qualifying child. Part C, rules if you do not have a qualifying child. And Part D, rules for everyone. Now, interestingly, Part D and Part A, Column 1, look really similar. And that's because they have to do with how much money you're making. Your AGI must be less than the amount shown here for your filing status and the number of qualifying children that you're claiming. But the other side of Part A is what's really interesting. Firstly, it says, number 2, you must have a valid Social Security number. That means if you have a fake number because you're illegal or your child is illegal, you cannot have the earned income credit. Number 3, your filing status cannot be married filing separately. 4, you must be a U.S. citizen or resident alien all year. 5, you cannot file Form 2555 or 2555EZ. And those are the forms that are used to exclude foreign wages from taxation. Number 6, your investment income must be less than $3,150. Investment income includes interest, dividends, and capital gain income. Number 7, you must have earned income. Oddly enough, it's called the earned income credit because you have to have earned income. But I have seen tax preparers try to give it on rental income. Can't do that because rental income is passive income. It is not earned income. Okay, Part B, rules if you have a qualifying child. Number 8, your child must meet the relationship, age, residency, and joint return tests. I want to point out that there are only 4 tests here. We're not talking about the same tests that are used to establish whether or not we can claim a child as a dependent, or whether or not we can claim a child for the child tax credit. The 4 tests we see here are the only tests that a child must meet in order to qualify you for the earned income credit. But a child can qualify you for earned income credit and not be your dependent. That is possible. So next, your qualifying child cannot be used by more than one person to claim the earned income credit. And 10, you cannot be the qualifying child of another person. Part C, rules if you do not have a qualifying child. And what I find is some people get confused by the rules in column C and stick them in column B. And that makes your clients very upset. Do not take rules from column C and put them in B because your client won't like that. So, and the rule I come to is this rule about age. You must be at least age 25 but under age 65. That's only if you don't have a qualified child, so please don't stick the age rule in column B. There's no age rule that applies if you have a qualifying child. It's only when you don't have a qualifying child. Rule number 12, you cannot be the dependent of another person. Number 13, you cannot be the qualifying child of another person. And number 14, you must have lived in the United States for more than half the year. All right, the IRS takes qualifying child and breaks it down for you into this nice little graph. You have a qualifying child if the child is related to you. And it defines what related means. Son, daughter, stepchild, foster child, or a descendant of any of them. For example, your grandchild. Or your brother, sister, half-brother, half-sister, stepbrother, stepsister, or a descendant of any of them. For example, your niece or nephew. And who was under age 19 at the end of the year and younger than you. Or under age 24 at the end of the year and younger than you. Or any age if they were permanently and totally disabled. Next, we have the joint return test. Your child cannot have filed a joint return for 2011 unless the only reason they filed that joint return was to make a claim for a refund. That means that they weren't required to file, and if did they have any tax on the return if they did file, because if they did, they were required. So essentially you're looking at, is their income so low they're not required to file, but maybe if they do file, they'll get some benefit from it. If that's the only reason they file, then you can get the credit, otherwise not. That's on a joint return. Your child can file a tax return, just not a joint return. And then finally, residency. Did your child live with you, in your home, inside the United States? So if your child lived in someone else's home, you're out. And they have to have lived with you for more than half of the year. So those are the EIC, or the EIC definition of a qualifying child. Now, you've gone through all of the rules there, and you say, I've got a qualifying child, hot dog. Here's the form that you fill out, and you will see it provides space for 3 children. The instructions for the form used to tell you to list the youngest child first. And tax software still does that. I can't find it in the instructions anymore. I don't find it. I've looked for it and said, well, it's a rule. You always put the youngest child first. But I can't find the rule in writing anymore. But tax software still does it. So what you'll find sometimes, especially in our Drake software I'm seeing this, but you may have it in yours as well, is that you'll list your dependents in the dependency screen, and then you have to go and do the checklist procedures for earned income credit. And the children that you identify under earned income credit, well, you might be identifying them in the order that they appeared as dependents, except that doesn't work because the checklist is going to apply the questions in the order that the children are appearing on the EIC schedule. So your software might be screaming at you that you haven't answered all of the due diligence questions, and you're pulling your hair out saying, but I did answer all the due diligence questions. What you haven't done is allocated the software to the correct child on the schedule EIC, and that may be a different order than you actually entered the children on the front of the 1040 form. Simply because on the 1040 form, you might naturally, and many customers often do, list the oldest child first. And then the EIC takes the youngest child and goes down, or youngest child first, second child is the second oldest child, and then the oldest child is the last child listed. I've been doing this a long time. Okay, Form 8862, information to claim the earned income credit after it was disallowed. Well, let's suppose you claimed earned income credit for a child, and you were not the one allowed to claim the child. Do you think that ever happens? All the time. Now, sometimes it happens by a true mistake. The person really legitimately thought they were allowed to claim it. But more often than not, they probably knew they shouldn't and did it anyway, or they had a tax preparer who said, if you get the child on your return first, you'll get the money, so let's just file it before the other person who's really entitled to the kid files. So eventually these things come back on you, and if it is determined by the IRS that you inappropriately claimed the earned income credit, the first thing that happens is you can't have it for 2 years at all. Don't get it. If the IRS determines that it was due to fraud, you can't have it for 10 years. Now, after you've gone your 2-year punishment period, you may reapply for the credit, assuming you actually qualify for it. And if you determine that your client actually qualifies for the credit and they were previously disallowed because they claimed it incorrectly, now you have to attach this Form 8862. And the 8862 asks all kinds of personal questions like, where did the child live? And what school did the child go to? Things like that. So you go through the form and you fill out answers to all of these questions, listing each child's year of birth, and then going through and saying who else might have had to claim the child or been eligible to claim the child. You go through the entire checklist, and once you're all done, then you file it with the tax return. Now, one of the things that goes on with electronic filing is if you file a tax return electronically with a claim for earned income credit and that form is not attached when it should be, the tax return will reject, and you will be given an error code that says this form is required, attach the form, or remove the credit. So let's assume you've decided through your interview with your client that they qualify for the credit, then you need to attach the form. Now, even though the form is attached, it doesn't mean they're going to get their earned income credit. The IRS can and very probably will audit them. And after it's finished its audit, then it might release the money. So as soon as a client is told by IRS that they need to attach that form, or you are told through a reject code to attach the form, you'd better let your client know it could be a few months before they see their refund. It's not going to be a matter of days that the average person is going to go. Now, it can happen. Sometimes they do get it in days, but rarely. Okay, also beginning in 2011, the Earned Income Credit Due Diligence Checklist is mandatory and must be filed with the return if the return is prepared by a paid tax preparer. So IRS previously had the checklist as something preparers were supposed to use. Then they had it as something you were required to use but keep with your records. And now it's something you are required to use but attach to the return as well. And it goes through and asks a series of questions. You go yes or no all the way through. Now the odd thing about the tax software I use, again Drake, is it asks questions sometimes in reverse. And so a question that's worded on the form in a particular way might be reworded the reverse way in the software. So you really have to pay attention to the wording of the question and make sure you answer the question correctly. And if your software is not giving the credit to someone you know is entitled to it, go back and review these questions, because somewhere you answered no when you should have answered yes, or you answered yes where you should have said no. All right, now on to the rest of my spiel. In addition to asking questions listed on Form 8867, the IRS also requires tax preparers to ask additional questions of a taxpayer when information appears to be incomplete, inconsistent, or incorrect. For example, my client is applying for the Earned Income Credit, and he tells me he only earned $15,000 during the year, except he's driving a brand new Mercedes. Now, how do I know he's driving a brand new Mercedes? Because he drove up in it and parked it in front of my store? Well, that would require due diligence on my part. There's something fishy going on here. I'd better ask questions. So how do you afford a Mercedes on your pay? That would be a pretty cheeky way of doing it. But, I mean, as the preparer, I have a very good cause to believe that that person is underreporting income simply by looking out the window. And the IRS says you cannot be blind to that. You cannot have information coming into you like that and ignore it. Due diligence is about having a brain and using it. Okay, so a preparer must not know or have reason to know that any information used to calculate the EIC for a taxpayer is incorrect. A preparer cannot ignore information that raises questions as to the legitimacy of the EIC claim. Now, a year ago, one of the staff in our office attended an IRS seminar where a man named Greg Thompson spoke on behalf of the IRS, and he had this advice. The key to preparing EITC returns more accurately, faster, and with higher customer satisfaction is practicing due diligence. Paid preparers must meet 4 due diligence requirements. 3 of the requirements relate to record keeping, and the 4th, the knowledge requirement, is where your expertise as tax preparers comes into play. Due diligence requires you know the law. You cannot use the excuse, I didn't know that. I'm so sorry, I just didn't know that. That doesn't wash. They will not accept that excuse. Also, it is not enough to know the law. You have to use your knowledge of the law to ensure you ask the right questions to get the right information to make the right determination. You cannot know or have a reason to know that any of the information provided to you by your client that is used to determine eligibility or to compute the credit is incorrect. And you need to ask follow-up questions until you get all the facts. For example, is that new Mercedes coming from unreported under-the-table income? You couldn't afford it possibly on this. You couldn't afford to feed the kids on this. So is there a girlfriend who earns a whole lot more than you that's paid for that car? Is it hers? I mean, there's no polite way to ask questions like that, but they have to be asked. And that's part of what goes on with tax preparers, especially inexperienced tax preparers. They feel uncomfortable about asking penetrating questions. Like, that's just none of my business. Why should I ask a question like that? Well, because the law requires you to. And if you don't want to ask those questions because they make you feel uncomfortable, maybe this isn't the job for you. Because the IRS is not going to have sympathy for you because you felt uncomfortable asking the questions. All right, so here is the IRS's due diligence checklist. Item number 1, complete Form 8867 and complete the form based on information provided to the tax preparer by the taxpayer. Now, I've been in this business long enough to see fraud scams going on, and I've had clients walk into my office dragging in their friend, or dragging in someone, or being dragged in by someone, right? And this someone proceeds to answer my questions for them. That is a key indicator that fraud is happening right in front of you. There's the lady, there's the man and the woman are not married, and they claim they're friends or cousins or something. And you ask the lady a question, but the man answers. That should have your alarm bells just screaming, red alert. In a situation like that, what I do is I say, excuse me, sir, would you please go sit in the waiting room? This needs to be a private conversation. It's a tax matter between me and my client. And get them out of there. And we have done that in our offices. And after I've done that, my clients have given me different answers than they gave me when that person was there. Okay, computation of credit. Keep the EIC worksheet or an equivalent that demonstrates how the credit was computed. Knowledge. Know the law. Paid preparers are required to know the law. And the preparer must not know or have a reason to know that any of the information used to determine EIC is wrong. Not ignore the implications of information furnished or known. And make reasonable inquiries if information furnished or known appears to be incorrect, inconsistent, or incomplete. Now, there is a confidentiality issue that goes on with every client. You shouldn't be blabbing on about your clients to other people in your staff. You should certainly not be blabbing about your clients to people you know at home. But sometimes it happens that you have a client that someone else in your office knows, and sometimes I've had one person in my office come up and say to me, that woman, her kid? My client claimed that kid last year. What's going on here? Those are the other types of things that you should be aware of. Is there something going on where they're fishing and moving around preparers in an office? Or the other thing that happens is they move from one tax preparation company to another tax preparation company 2 blocks down the street, each year trying to change their story and maximize what they get. So you have to be thinking along those lines as well. Am I being fished? Record retention. Retain Form 8867 and the EIC worksheet or the equivalent. Maintain records of how and when the information used to complete these forms was obtained. Verify the identity of the person furnishing the information. That means you need to see their identification. You cannot file a tax return for a person who has not presented ID to you and proven to you that they are who they say they are. And then finally, you need to retain records for 3 years after the June 30th following the date the return or claim was presented for signature. So if I prepare a tax return on February 12, 2012, June 30th, 2012, I got to go all the way out past June 30th of 2015 to be at that 3-year point. Now, Mr. Thompson also gave an example of a situation where further inquiry should be made by the taxpayer, and this has nothing to do with the car that was too expensive. His example is very different. If a young mother who lived with her parents and made $3,000 tells you that she qualifies to claim her child for the earned income credit, would you question whether this mother is in fact a qualifying child of her parents and therefore ineligible to claim the credit? The information in this scenario should raise questions in the mind of the preparer, and it also raises the responsibility under the law. to ask your client additional questions. Hear no evil, see no evil is exactly the wrong approach to due diligence. I'm tongue-tied now. Another part of due diligence is the knowledge requirement. The knowledge requirement is to document additional questions you asked and your client's responses at the time you received the information. So we have the due diligence checklist. You go through and you answer all the questions. But maybe your mind got going a little and you started to ask other questions that are not on the form. IRS says you should keep a written record of those. I personally use my tax software to do that because my files for my clients, you know, when you write on them by hand, they do go into a paper file drawer and get shoved away. But 2 years from now, well, actually when the statute of limitation expires, at least for our company, it's about 4 years, we start shredding. So written records that went on 3, 4 years ago might be difficult to find or they might be gone. But my tax software backups last at least a decade. I'm able to retrieve tax returns from our system that we filed a decade ago. So if I'm able to go into old tax software and see notes that I took at that time, that's much easier for me to access and will be retained for a much longer period of time. So pretty much every tax software I've ever worked on has had some kind of a field where you can enter notes. And I use those notes screen to describe any questions I asked my client, any answers that they gave me, and my conclusions based on the outcome of that interview. And I have, in fact, written comments on computer screens. This client attempted to claim a dependent they were not entitled to claim. I told them they were not entitled to claim that credit, and I leave that note in there. And a year later, if that client comes into our company and sits down with another preparer who doesn't know them, that note will be there. It may also, for my part, have a note that says something like, well, Jane lives with her mother. Jane is not a dependent of her mother and is not a qualifying child of her mother. And I'll describe all of the questions that I asked Jane so that I finally came to the determination that Jane is in fact entitled to the credit. And I have those notes in there. And a year later, when Jane comes in and sits down in front of me, I go, oh yeah, I remember that. And I'm already in a position to say, are you still with your mom? And how much did you make? And those types of questions. Because believe you me, I've gone a day where I've done 8 tax returns in a day, and I've gone at the end of the day and picked up the file that I started the day with, and I could not remember that person. They sat in front of me for an hour and 15 minutes, and I cannot remember them to save my life. But I got this file with their personal information in it. Okay, in our business, you just cannot remember every detail of every person, and notes are your salvation. Now, if you are a person who deals with the earned income credit at all, the IRS has a website that you can go to, and I've got the URL linked to it here in the manual, and I went and checked it out. It's kind of cool. It has videos, and they're really funny. Kind of like the old private investigator videos with the sultry jazz music and the tax client waddling in and sitting down and filing her nails and chewing her gum and trying to get earned income credit. And it's so true. I mean, it's exaggerated in the film, but it really shows you how a preparer should handle a situation like that, the types of questions, and also shows the client reacting to it unfavorably. Because if you send a client home to get proof for you, do they like you because you sent them home for proof? Do they complain? Now, this due diligence thing, I'm giving you an example under earned income credit, but it applies to any kind of situation where your client is trying to claim anything on their tax return. If you ask them for something that isn't convenient, they're not going to like you for it. And the fact that it's not convenient to them does not mean you can ignore it. So earned income credit is just all the more emphasis on due diligence, all the more scrutiny on due diligence. But due diligence applies across the board to every number you put on every line of your tax return. Okay, so best practices for due diligence. Ask all the right questions. Get all the facts. Document as you go. That is, keep a written record of all questions you asked, the answers provided by your client. Don't rely on tax software alone. Keep up on training and education. Scrutinize questionable returns. Turn away dishonest filers. Review the return for quality. This means managers should review the work of their tax preparers. In Oregon, that's a law. But it's the only state where it is a law. In Oregon, the law requires that if you are a tax preparer, someone overseeing your work must review every return you prepare. That rule only goes away when you become a tax consultant, but we're the only state with that rule. Outside of Oregon, there's no law that requires review. However, due diligence for earned income credit, the IRS specifically states that the tax return should be reviewed for quality. So that means if you're a manager of a tax service and you've got preparers preparing EIC claims underneath you, it's your responsibility to make sure that they're filing those claims correctly. Even though the penalties of tax returns filed in 2011 and earlier years, that penalty was $100 per violation. Beginning in 2012, that penalty has increased to $500 per violation. Now, in 2011, the IRS started sending out letters to tax preparers that it identified as having higher than average adjustments to tax returns that had claims for earned income credit and to tax returns that had claims for self-employment, I think rental property, and Schedule A. So the IRS is using the new PTIN system, Tax Preparer Identification Number system, to identify the accuracy rate of tax returns that preparers are filing. And where it establishes that that tax preparer falls outside of the norm, that tax preparer is now receiving a letter. And tens of thousands of them went out last year. If you got one of those letters, the IRS is looking at you very carefully. And you cannot underestimate the importance of improving your diligence and improving your accuracy. Now, one of the areas of inaccuracy on tax returns, one of the most common errors ever made on all tax returns across the board, EIC and otherwise, is the head of household filing status. The head of household filing status is allowed under the law when a taxpayer meets specific tests. The law often conflicts with what a client believes their status should be. For many filers, head of household can mean the man of the household or the person in the household who earns the most. But these ideas of head of household are not IRS definitions. It is the tax preparer's duty to determine if a client meets all tests for head of household and qualifies for that status. A good tax preparer learns to phrase questions to his or her clients in non-technical terms. So here are some do's and don'ts of due diligence. Due diligence demands the tax preparer ask questions that can help you determine if a client meets the conditions for receiving specific tax benefits. Earned income credit, head of household, dependent, tax deduction on their tax form, Schedule A, or on their business tax form. What are the types of questions you should ask? Well, firstly, don't ask, are you the head of the household? Well, that's my job as the tax preparer to decide whether you're head of household. If I ask you head of household, well, why are you here? You can do your taxes on your own if you already figured out filing status. That's 90% of my job, is getting that right. Top line on the tax form, select the right filing status, and that can be hard. Okay, so you don't ask them if they are the head of the household, or don't say something like you are the head of the household, right? And get a confirmation from the client. That's completely the wrong way to do it. So what do you say? Well, you ask all the questions needed to determine the filing status choices your client qualifies for and which of these filing status choices will benefit them most on the tax return. For example, were you married on the last day of the year? Did you pay more than 1/2 of the cost of keeping up your home? Those are two questions that are mandatory if you're going to make an establishment that a person qualifies for head of household. If you don't ask those questions, you're already negligent. And people change their filing status year to year. Have you noticed? You know, one year they're married and the next year they're not, and so on. And of course, we have an entire course just devoted to that. It's called Filing Status and Dependence, where we really go through all of these rules and teach them to you. Now, here's another one. Don't ask. How many dependents do you have? Instead, you should ask questions that help establish that a client meets requirements for claiming a particular filing status and if they have dependents. Examples of these kinds of questions could include, please tell me about your family situation. Do you live alone or with other people? who are the people you live with? Whose home do you live in? Do you own your home or do you rent it? If you rent, is that your name on the rental agreement? Who else lives with you in your home? Are there any other people who lived with you during the year? How many months did your children live with you during the year? Did your children spend any time with other family members who lived or did not live with you during the year? Is there anyone else who helped care for your child? And if so, what is that person's relationship to your child? Etc., etc. Those are the types of questions you should ask. You should not ask, are you the head of household and how many dependents do you have this year? Or who are your dependents this year? Over and under reporting income. To avoid errors and to comply with due diligence requirements, tax preparers need to be on the lookout for questionable W-2s or business income that works to either qualify a taxpayer for earned income credit or to maximize the amount of earned income credit. Now, believe it or not, there is a rule under earned income credit that says if you are getting the earned income credit due to self-employment income, you calculate that earned income credit after you have claimed all allowable expenses. So you might have a client that grossed $15,000 on a child daycare in their home. And they come into you and they say, yeah, I don't have any expenses. Okay, well, did you feed the kids? And if the kids were with you in the home, then you probably qualify for business use of home, which is deductible. So it's impossible to have no expenses. So you can't ignore that there probably are expenses, and the law, oddly enough, requires that you put some down if it's reasonable to expect that they had them when it comes to the earned income credit. Now, when we're doing a Schedule C audit for a person who doesn't have earned income credit, the auditor's going to be kind of looking in the other directions. Prove to me you had the expenses. But on earned income credit, if the expenses are such that EIC has been maximized, the auditor might say, prove to me you didn't have expenses. So the instructions for the earned income credit claim are that you file an accurate Schedule C for a self-employed person that claims all allowable expenses. And after you have filed an accurate Schedule C, if they're entitled to the earned income credit, by all means give it to them. But no, do not attempt to work the Schedule C P&L to maximize the credit. They'll nail you. Eventually you'll get caught. Maybe not on this client, but if you do enough of them, it'll catch up to you. All right, also you should be looking for fake or altered W-2s and 1099 miscellaneous forms. So a handwritten 1099 miscellaneous form in a fishy story might be a reason to verify the accuracy of that 1099, maybe by calling the business that issued it and making sure that they actually did issue it. I've done that. I've had a W-2 in front of me that I knew was fake. It was like, the Social Security calculations on it were wrong. The withholding was absurdly high compared to the wage amount reported. I went, this has got to be the fakest W-2 I've ever seen. And I did everything I could to find that business. It was non-existent. So, yeah, that tax, I just turned that one over to the IRS. I thought this is prime for the fraud department, and I turned it all over. And that was the last time I saw that client, oddly enough. Okay. Earned income credit checklist. This is one of the 2 colored pages that the IRS has on its website that you can print, and you could then post it on your desk, turned around so your clients can read it, and walk them through the rules. One of the things that goes on with clients is they are suspicious that their tax preparer may not know as much about the earned income credit as they do, and very often they're right. I've been doing taxes for 20 years, and for 20 years I've been listening to my tax preparers interview tax clients and make determinations on their earned income credit. And remember that story I said, do not take the age rule for the person without a qualifying child and put it in the column for a person who has a qualifying child? That's based on experience. I've had preparers working for me who have done that. And then my clients have come to me and said, your tax preparer does not know what they're doing. I think they did my taxes wrong. And I ask them a few questions and I go, you're right. You know more about this than my tax preparer does, and that's highly embarrassing. So when I focus on something until it's just like driving you into the brain, why is she talking about this? Because it's kind of trying to make a point. And if you own a business, it matters that your preparers get it. And if you are a preparer, it matters that you get it from both sides. So how can you help do this? You have the checklist on your desk. You read through it with every single client. You show it to every single client to make sure they understand the rules too. And then if the client is suspicious that you were wrong, but they can see in writing in front of them that you're right, maybe they're going to be more inclined to stay and not take their W-2s and walk out. I personally don't like it when my clients take their W-2s and leave. I feel defeated. Don't like that. Okay, so qualifying tests for EIC, I've already gone through these with you, but this is just one more chart. Again, something you can put on your desk. And it's got the tiebreaker rules down at the bottom. And of course, the tiebreaker rules are all about what to do when two people qualify to claim the same child. And the IRS looks very carefully at tiebreaker rules because under the tiebreaker rules, you can have two people that are entitled to the child. If both of those persons are the parents of the child, then the credit goes to the parent who lived with the child the longest. If both parents lived with the child the same amount of time, the earned income credit goes to the parent who earned the most money. If the two people who are entitled to claim the child, one is the parent and one is someone other than the parent, no matter what, the parent wins. And the final equation is you have two persons entitled to claim the child and neither of the persons is that child's parent, then the person with the highest income wins. You have to know those rules. If I spout them off and they sound easy, they're actually not. I've just said it enough times over enough years. But they're here in writing in front of you. Okay, on to the first-time homebuyer credit, and it is a refundable credit. So even though we talked about the first-time homebuyer credit a little bit ago, we did so underneath payments. And now we're into getting a refund from it. But I can also see we're due for a break. So let's take 10 minutes, and when we return, we will move on to the first-time homebuyer credit. Okay, so we're down to the last hour and a half here. How am I doing on time? I'm up to 138 of 178. I think we're going to make it. I'll just speed it up a little bit faster. Well, earlier in the tax season, the IRS had a webinar on the new registered tax return preparer rules, and I was all ears. I wanted to hear all about that because, of course, I run a tax school. So I tuned in and I listened for an hour, and when I was done, I got my certificate of completion for an hour of CPE. And my thought was, wow, what a deal. I got an hour of CPE for 10 minutes of education. Because really, everything that was provided to me information-wise in that webinar could fit into 10 minutes at the most. It was just very slow, methodical explaining and re-explaining the same few pieces of information. And that's very, very different than the way I teach, obviously. Okay, so let's move on back to where we left off, which is the lifetime learning credit. And as I said earlier, we talked about the repayment of the credit, but there are still a very small group of individuals who will qualify for the credit on their 2011 tax returns. And those include members of the military and certain other federal employees serving outside of the U.S. They have additional time to buy a principal residence in the U.S. and qualify for the credit. The first-time homebuyer credit has expired for most individuals. However, the following individuals may still qualify for the first-time homebuyer credit for homes purchased in 2011. And they include members of the uniformed services. My husband is former military, and he thought that I had worded that incorrectly. But no, I did not make that up. That's the description that the IRS is using, and one can extrapolate from that that they mean the armed services or the armed forces, right? The other is members of the Foreign Service and employees of the intelligence community. The extension of time to claim the credit applies only to any individual and, if married, the individual's spouse who serves on qualified official extended duty service outside of the United States for at least 90 days during the period beginning after December 31, 2008 and ending before May 1st, 2010. An eligible taxpayer must buy or enter into a binding contract to buy a principal residence on or before April 30th, 2011. If a binding contract is entered into by that date, the taxpayer has until June 30th, 2011 to close on the purchase. Restrictions on the credit include that dependents are not eligible to claim the credit. No credit is available if the purchase price of a home is more than $800,000. A purchaser must be at least age 18 on the date of the purchase. The amount of the credit, generally the credit is the smaller of $8,000 or half that amount for married filing separately, or 10% of the purchase price of the home. When to claim the credit, eligible homebuyers making 2011 purchases can get an early benefit by claiming it on their 2010 return. If they did not claim it on their 2010 return, they can wait to claim it on their 2011 return. And this is such an abbreviation of the rules because we've really moved past the point where people are claiming it except for the select group. So if you do have a person who thinks they qualify for the first-time homebuyer credit, or you find out that they did buy a home in the early part of 2011 and they had been outside of the country, then I would definitely go to the Q&A page that the IRS has on the first-time homebuyer credit and go through all the rules, make sure they qualify. And if they do, then it means filing a paper tax return with the Form 5405 attached, plus a copy of the HUD statement that has been signed by the paper and all of the other paperwork that needs to accompany it. Form 1040, line 71B, the adoption credit. Now, the adoption credit is not new, but the refundability of it is. In 2010, it became a refundable credit, and it was not hard to predict that it was going to be a paperwork nightmare on the tax preparation end, and of course, it followed through with that promise beautifully. All of our clients who qualified for the adoption credit did eventually receive it, but it took several months. We're talking more than half a year month, okay, for the credit to finally be allowed. And the thing with the IRS is when you send in a paper tax return with paper forms attached to it, the IRS loses parts of it. So what I do is before I put a tax return in the mail, or before I give my client a tax return to mail with all of the appropriate attachments, clearly I triple staple it every which way I can. But the other thing I do is I make sure I have backup copies of everything that went out to replace the copies the IRS will surely lose. Because what will happen is it'll get there, they'll either not see what's already in there because they're blind, or what should be there was lost. In any event, they ask for the information that was previously sent, and you just need to be prepared to send it. And there's no point in getting upset about it because you know it's going to happen. I say the same thing about the W-7 application for a a tax ID number for non-resident aliens who are not eligible for a Social Security number. That procedure of attaching identification and sending it off, they always lose those pages too. One year I had a client that we made an attachment of 4 W-7s for 4 dependents. The IRS lost 3 of them. And then we sent the 3 in that they'd lost, and they lost 1 of the other 3. And I think they've gotten better. This was a couple, 3, maybe 5 years ago now that I went through this. Maybe not that long ago. They feel like they've gotten better, but not on the adoption credit. Okay, so let's talk about the rules for the adoption credit. You may qualify for the adoption credit if you adopted or attempted to adopt a child and paid qualifying expenses relating to the adoption. The amount of the credit is as much as $13,360 for 2011. You may be able to claim the credit even if the adoption does not become final. If you adopt a special needs child, you may qualify for the full amount of the adoption credit even if you paid few or no adoption-related expenses. If you carried forward an adoption credit from 2005 or later because the credit was more than the tax you owed, you could claim the carry-forward amount as a refundable credit in 2010. You can find the amount of any unused carry-forward amount on line 23 of the worksheet on page 5 of the 2009 Form 8839. So why am I repeating this for 2011? Well, it does occasionally come up that a person qualifies for the adoption credit even though they had no adoption expenses. Now, most people who qualify for the adoption credit because they paid out a bunch of money to adopt the child, they know about the credit because it cost them a ton of money and they had enough money to pay for the adoption, right? They came up with the money and they may have involved an adoption agency, and that adoption agency would surely have informed them about the rules. But you've got this other group of people out there who may adopt a child and had no expenses related to that adoption. And the reason they have no expenses is they adopted a special needs child, typically in the custody of the state. And so they've gone to the state and they said, I'm interested in adopting a child. And the state says, I have this 5-year-old boy here that might be a good match for you. And you go through the process. It's decided you adopt this child. This child comes into your home and no expenses whatsoever were paid. Odds are that child is a special needs child and that person qualifies for the credit, a refundable credit of $13,000, even though they paid no money out. Now, it can also be the case that that special needs adoption occurred in an earlier year, and it just happens to be that during the part where you're exercising that due diligence that you're so good about, you happen to notice that the child's got a different last name than the filer. And the filer says, this is my daughter, Annie, and you go, but Annie has a different name than you. Is this her father's name? That would be a logical thing. Oh, no, Annie's adopted. Oh, really? When did you adopt Annie? How did you adopt Annie? Was there, an adoption agency involved? How much did it cost you? So somewhere in there, you may establish that an adoption credit was allowed in an earlier year and was claimed or wasn't claimed. And even if it was claimed, maybe the carry forward got dropped somewhere along the line because the tax preparer or the taxpayer didn't know that there was a carry forward. So it is possible to go back and reconstruct some of these and pull them forward to 2010 and give them a refund. So that's the first side. Special needs children are children deemed to be special needs by the state. You might think of a special needs child as a child who has a disability that is obvious to the world. Autism, mental retardation, mood swings, erratic temperament. Those are the things that might jump to mind as special needs. But special needs, as far as the state is concerned, is a child who is difficult to place. And the state will decide whether a child is deemed special needs. It's not you, the taxpayer, decides it. It's not the client that decides it. It's the state. And the case that I'm thinking of is a client that I had a few years ago, long before the adoption credit became refundable. And I had this exact situation. Your child's got a different Social Security number than you, but you're calling her your child. And then she says, well, she's my sister's child and I adopted her. Oh, really? Well, why did you adopt her? Well, because my sister went to prison. So there was nowhere for the daughter to go, and I took her in, and then, the state asked me if I would adopt her, so I did. And I thought, well, that sounds like a special needs adoption to me. And I said that to her, and she says, there's nothing wrong with my kid. She's totally healthy. And I said, well, you go check with the state and see if this child is a special needs child as they define it. And the answer was, yes, she was special needs. And we went back and amended and got her money. Now, because she was lower income, that carry forward could have been going on for several years. And then in 2010, whammo, she gets that refund. So what are the rules for claiming the adoption credit in 2011? Well, clearly, because anything that was refundable from earlier years was refunded in 2010, we're not dealing with carry forwards into 2011. For 2011, we're looking at adoption expenses that occurred in 2011 or for adoptions that were finalized in 2011. So the maximum credit is, again, $13,360 per child. There is a phase-out based on your income, and if your income is between $185,210 and $225,210, the credit phases out, and if your income exceeds that amount, you don't get it. But it's a pretty generous income level. Most people who, adopt children are lower than that. So most people who adopt a child qualify for the credit. Qualified adoption expenses are the reasonable and necessary adoption fees. They also include court costs, attorney fees, traveling expenses, including amounts spent for meals and lodging while away from home on the trip to China to adopt that child in China. Totally allowable. Other expenses directly related to the legal adoption of an eligible child. Expenses paid in an unsuccessful attempt to adopt an eligible child before finalizing the adoption of another child can also qualify for the credit. What expenses do not qualify? Expenses for adopting your spouse's child, or for a surrogate parenting arrangement, or that violate state or federal law, or are paid using funds received from a federal, state, or local program, or are paid or reimbursed by your employer or any other organization, or are allowed as a credit or deduction on a federal tax return. You cannot claim a credit for the same adoption expenses used to claim the income exclusion. But it is possible to claim a credit and an exclusion for adopting the same child. For example, if you spent $20,000 adopting your child, you could qualify for an adoption credit at the same time your employer could have paid for part of that adoption and excluded from your income. So who is an eligible child? An ineligible child is a child who is under the age of 18 or an individual who is physically or mentally incapable of caring for him or herself. In other words, you could adopt an adult if they met that definition. When do I claim the credit? Well, it depends. If you adopt a child who is a U.S. citizen or resident, you can claim the credit any year before the year the adoption is final, as long as it was the year that you paid, any year before the adoption is final, but if the adoption is not final, you claim the credit in the year after the year of the expense. If it is the year that the adoption is final, then you claim the expense in the year the adoption is final. And if it is paid in any year after the year the adoption is final, then you pay it in the year of payment. But if you adopt a foreign child, and most of my clients that do adopt children are adopting them from China. I'm sure we're all aware of that's a hugely popular place. Korea is also popular. If you paid expenses for that kind of adoption, and you paid those expenses in any year before the year that the adoption is final, you can only claim them in the year that the adoption is final. And if you pay them in the year the adoption is final, you claim them in the year it was final. And if you pay them any year after the year the adoption is final, you claim them in the year of payment. There's more information in here about excluding adoption expenses that were paid by your employer from your income. I'm not going to read that to you. Let's move down to what records should I keep to claim the adoption credit or income exclusion. Well, the records include receipts for qualified adoption expenses, entry visas for foreign adoptions, a final decree, certificate, or order of adoption, home study by an authorized placement agency, child placement agreements or court orders, and determination of special needs status by a state or the District of Columbia. So if you're making a claim that I have a special needs child, you have to maintain that certificate, and actually you'll have to mail it in with the tax return if you want that money. And the third password of the day is EAGLE, E-A-G-L-E, as in our national symbol, right? And here is the Form 8839. And yes, it is possible to get $13,000 for each child. That is definitely made clear on the form. There's a question, how long do you have to keep the child? Okay. All right. Next line of the tax form is refund. Hey, we've gone through all of the payments. Now we've got to the refund line. And what do we do with that refund? How do we get our money? Well, there's all kinds of different ways that the government can give us our money. And we make those choices sometimes, not always, but sometimes we make those choices on Form 8888. Series I bonds. The IRS now allows you to invest part or all of your federal refund to buy Series I U.S. savings bonds. You can purchase Series I bonds in multiples of $50. The balance of your refund is issued as a paper check in the mail or by direct deposit to your bank account, depending on which delivery method you choose. You should receive your savings bonds about 3 weeks after you receive the remainder of your tax refund from the IRS. So how do you complete the form? Well, you use Part 1 to tell the IRS the portion of your refund that you are not using to buy savings bonds. That means the amount you want them to send you. Use Part 2 to show the amount you wish to invest in the bonds. Use Part 3 if you want to receive the balance of your refund as a paper check in the mail. And then in Part 4, you add up the amounts in Parts 1, 2, and 3, and the amount shown on the line of Part 4 should be the same as your refund on line 74 of your 1040. Because if there was a difference, you've got a math error somewhere, and they would be confused. You don't want to confuse the IRS. It just takes a lot of extra time. So here is the Form 8888. One of the other things you can use the form 4 is to divide a refund between multiple accounts. So on the Form 1040, you can allocate a client's refund for direct deposit to their bank account, but it only provides space for a single account. If your client wants to have the refund divided between 2 accounts, for example, you may have a husband and wife and they both want their share of the refund into their separate accounts, you can do that with this form in Part 1. While we're on the subject of refunds, let's talk a little bit about refund anticipation loans. Now, some of you may find that this is a very big part of your business. Some of you might say, I've never done a refund anticipation loan in 20 years. This is such a waste of my time. Well, unfortunately, I feel it's necessary to talk about stuff that large numbers of taxpayers use. And so I feel even though it's not for everyone, you should still at least be aware of the rules and what's going on. The refund anticipation loan industry has been around for close to 20 years. And this is the last year of it. 2011 is the last year refund anticipation loans of any kind will be issued. The IRS has essentially shut them down. The only last remaining holdout that is offering refund anticipation loans is Republic Bank. Republic Bank is being used by some Jackson Hewitt offices, probably all of the Liberty Tax Service offices, and hundreds or thousands of independent tax services out there. It is not used by H&R Block. H&R Block did not offer refund anticipation loans in 2011. It will not offer them again in 2012. So why has the IRS shut it down? Well, it's been said for many, many years that the banks that offer refund anticipation loans and the tax services that push them on their clients are using predatory lending practices that take advantage of lower income people, particularly people entitled to the Earned Income Credit. Now, if you are like me and you've had clients for the past 20 years who come in every year with nothing more on their mind than Santa Claus is coming with their Earned Income Credit check and they're going to pick it up from your office, you know that the clients may feel very differently about this. It is people who analyze the industry and the practices of the industry who have decided that these are predatory, not necessarily the clients who are receiving them. So there's lots of clients out there who are upset that they can't get them. They don't understand why they can't have them. And they're wondering why they're gone. And even though Republic Bank is offering them, it's offering teeny little checks, $1,500. So if your client has a $6,000 refund, they're only going to get a check for $1,500. Is that going to make them happy? Well, it's the best deal in town because the other deal is there's no refund loan at all. That's the only deal. Now, to qualify for a $1,500 loan, the refund must be $2,000 or more. And if the refund is more than $2,000, they may qualify for the loan. If they qualify for a loan, they'll get the $1,500 check, usually overnight, and then the balance of their refund will come after IRS deposits the money. That's how the system works. What's the amount of time that the loan lasts for? Usually a week. If I file and get a refund loan today, my refund would probably come to me in its entirety without a loan a week from now. So it's a very short-term loan, and of course the thinking behind it is you don't need a loan that only is for 7 days or 10 days. But a lot of clients really don't blink an eye at paying $100 to get their money 7 days earlier. They don't give it a second thought. My refund's $6,000, so what if I get $5,900 instead? Give it to me now. That's what's on their mind. So at any rate, it is going out, and I feel that I've observed it in my staff over time. I've also observed it in other tax preparers over time, that most tax preparers do not understand how the system works. And that's part of what the problem has been. Is it not Nightline, but one of those types of shows that does the investigative reporting in an hour-long show. It was the NBC one. Anyway, they did a thing on the refund anticipation loan industry, and they particularly at that time targeted Jackson Hewitt offices. And I remember watching it when it came out. And what they did is they had hidden cameras. They went into the offices of a Jackson Hewitt office in some state in southern United States. And the tax preparer was telling the client that the refund anticipation loan was the best way to get their refund. And that was the wording they were using. They had a chart there of the refund options that said, but this is the one you want. And it was the most expensive option, but that's the one you want. That's the best one. And so the client opted for that and came out, and then the hidden cameras asked them a few questions, and then the reporters went in and talked to that tax preparer. And it was obvious to me that that tax preparer had no clue why that was the best option or the worst option. All they knew is they had been told to say that to their clients by their employer. They had no idea how the program worked, why it worked the way it did, and why it may or may not be an option worth considering for a particular client. So today I'm going to explain a little bit about electronic filing and how it coordinates with refund anticipation loans, refund anticipation checks, and direct deposit. Because guess what? A refund anticipation loan is direct deposit. There's no difference in the mind of the IRS between direct deposit to a client's own personal bank account and a refund anticipation loan. How can that be? Well, here's how the system works. You are a client and you go into a tax firm and you ask them to prepare your tax return, which they do, and then the tax return is electronically filed with the IRS by that tax service. But that refund section on line 74 of your tax return where you enter the direct deposit account information, the numbers that are put in there are the numbers for, in this case, this year, Republic Bank. And they're probably going to include your Social Security number, that is the filer's Social Security number, and a routing number for Republic Bank. And that tax return gets filed electronically. At the same time it's filed electronically with the IRS, an electronic file goes to the bank. And the bank looks at that client. They're going to run a credit check. They're going to look for delinquent student loans, child support collections, back tax liens. They also look at where's the refund coming from. Is it a big refund? Is it all from earned income credit? What is the filing status of the filer? Do the children on the tax return have the same last name as the filer? It's looking at all of those things, trying to make a conclusion of whether or not they're going to lend that $1,500. Meanwhile, IRS is processing the tax return and comes back and accepts it with an acknowledgement. At the point the IRS accepts it with an acknowledgement, the bank has made a decision whether they're going to lend or not. If the answer is yes, I'm going to lend, the check gets printed and delivered to that client. Now the bank's out $1,500 and is waiting to see if a week from now the IRS deposits that money. Is there any risk to the bank? Absolutely there's risk. The reason there's risk is that the IRS could hold that refund. The IRS could decide to audit the earned income credit. The IRS could decide that there's a tax lien and all of the money is going to go pay that debt. So the bank is out $1,500. Guess who else is out the money? The tax preparer. Because the tax preparer typically sets it up so that their tax refund will pay their tax preparation fees. So the tax preparer has delivered a service on the promise that they will get paid from a refund. And if that refund never comes, the tax preparer is not paid. And what percentage of these tax returns that file for refund anticipation loans default? It depends on where in the country you are. But if you look at the percentage of tax returns that the IRS does not deposit on, the highest I ever saw was 20%. Pretty significant risk. And early on in my early years in this business, I had a tax service booth in a Newberry store in downtown Portland, and my default rate, or my flip rate as we called it back then, was close to 40%. So over the years, the banks have gotten better at this, and they figure out who to lend to with greater certainty and lower risk. For me as a tax preparer, I got better at turning away the shady ones and giving up the business because I didn't like doing tax returns for free. It just annoyed me to do tax returns for free. So over time, I've gone from seeing refund anticipation loans being a very, very large percentage of my business to being tiny, almost insignificant. But we still offer the product, not because I'm a predatory lender, but because my competitors offer it. And I want to offer a product that they can get down the street. And it isn't because I approve of the product, but if my customer wants it, I'm going to give it to them. So I personally love the fact that they're going away. I think it's great. I would love to see a system come in where the IRS could pay our fees out of the refund directly, and we'd get rid of the bank altogether. Now, even though the refund anticipation loan is going away, the RAC is not. And the RAC is a different concept. With a refund anticipation loan, the bank gives a check for $1,500 before IRS releases the refund. With a RAC, the bank does not issue any money at all until the IRS delivers the refund. So why would we involve a middle party bank and not get the money any faster? What would be the motivation for that, especially if I have to pay more than $100 extra for that service? There's multiple reasons. One is the client cannot afford to pay the tax preparer up front. So this is the only way to get the tax return professionally prepared and electronically filed is if my tax preparer gives me a rec. And there the taxpayer is on the hook for the tax preparation fees until IRS does that deposit. The other reason is, and I run across this frequently, my client may live in a home and she's afraid someone is going to get to her check in the mailbox before she does and maybe steal her refund check. Not everyone lives in secure single-family houses with relatives who are honest. Some people live in less certain situations, and they like knowing that their check will only be one place and that when they come pick it up, they're going to have to show ID, and then they're going to walk out of that office down to a bank and cash it and know that they have that money. So that's another reason people do it. And the third reason people do it is direct deposit is attractive to them, but no bank will allow them to have a bank account because, well, they've not been behaving over the past few years, and they bounce checks and use debit cards when there's no money in their account, and the banks just won't let them have accounts anymore, so they can't do direct deposit because they don't have an account. RAC stands for Refund Anticipation Check. Now that check can be delivered in the form of a paper check. It can also be ultimately delivered through direct deposit. It's technically possible for a client to come in, you prepare their tax return, you electronically file them, their refund goes to the RAC bank, their fees are withheld, your preparation fees are withheld, and what's left goes directly to your client's bank account. That can happen, and it does all the time. So there's a lot more banks out there that continue to offer RACs. Republic is the only bank offering RALs, but there's lots of different RAC banks out there. And I went online and found a few of them and listed them. There could be more than I've listed, but those are the ones I could find. So all right, let's talk now about refund offsets, because we've talked about refund delivery methods. Now what happens when your client has a refund coming but they didn't get it? And how often does that happen? Well, it happens at every income level and every socioeconomic status at some point may end up in an offset program. So we're going to talk a little bit about offsets because when they happen, your clients are upset and they may come to you. Sometimes they're accusing you of stealing their refund, and other times they're asking for your help in getting their refund. But either way, you really need to understand the process of what's going on so that you can give knowledgeable, factual, accurate information to your clients. So let's look first at what goes on with an offset. Offsets happen when your client owes the government money. They also happen in certain situations with delinquent child support and delinquent student loans, and when they owe the state money. So indirectly, I have a parking ticket from the state of Oregon from 20 years ago. Could that offset my federal refund? Highly unlikely, but it is possible, because the state agencies do send that information to the IRS, and the IRS can collect on it. But it actually doesn't go directly to the IRS. It goes to a middle party called Financial Management Service, or FMS debt. Now, up until 2010, the IRS used to give us something called a debt indicator. And banks use the debt indicator to qualify a person for a loan. In 2011, the debt indicator went away. But the debt indicator was helpful, and whether our clients applied for a RAL or a RAC or just wanted the refund to come in the mail or did a direct deposit, whichever way they filed, we would receive a debt indicator. They either had no debt showing up, or we would get an I code, or we would get an F code. I meant that they owe back taxes to the IRS. F meant that they have an FMS debt, which is child support, or claiming too much food stamps. So you apply for food stamps when you're not entitled to them, and they pay you a bunch out in food stamps, and then later on they figure it out, time to pay up, and they'll take it out of your refund. Okay? But it doesn't happen that quickly. There's a collection process that goes on. Maybe you illegally claimed those food stamp benefits back in 2008. And since 2008, you filed your 2008, 2009, 2010 tax returns, and everything's come peachy keen. And 2011, you file and your number's up. They took it all to pay that debt that's been on the book for years. So we don't get a code F anymore. All we know is their client's money didn't show up. And they think we did the tax return, and so their money didn't show up. It must be our fault. So one of the reasons you can figure out that the IRS took their refund and applied it to a debt is when a partial deposit occurs. Their refund was supposed to be $4,322, except only $3,512 showed up. Somewhere 600 and something's missing, and it probably went on that food stamp debt that they long ago forgot about. There's a question in the classroom, can they take the entire refund if you owe more than the refund? And the answer is yes, they do. They're very good at that. All right, so what does a person do when they have a debt? Well, FMS tells the IRS that they're going to do collection on a debt. FMS does not tell the IRS who the debt is for. The IRS does not know what the debt is for. It only knows that it's been told to collect. And it sends the money to FMS. FMS takes that money and sends it to whoever is owed. And meanwhile, you got the taxpayer here in a frenzy wondering where their money is. And they come to you, and you can't help them. So they call the IRS. The IRS can't help them. So then they call FMS. FMS doesn't help them either. But FMS will tell them who they owed the money to and where it was sent. And then they go back to that original agency. And if they get anything back out of that agency, it's directly through that agency. Now, the flip side of this is I've had clients who've had debts on the books for years. And in anticipation of receiving their refund, they put it all together, and they go down to the agency that they owe money to. A week before they file the return, they pay it off. And then they come in and they see me. And IRS grabs it. Because there's a delay there going on. From the time they pay off that agency till the time FMS is informed, and from the time FMS tells the IRS, could be weeks or months. So I wouldn't be advising to my clients, rush down and pay off that debt. Actually, the reverse. The question is, let's call FMS and see how much you owe. If it's less than the refund, we can do that rack for you, because if you owe $1,000 but your refund's $5,000, we'll do that for you. So let them take their $1,000. It'll all be paid off. Let the IRS deposit what's left. Let's have the tax preparation fee withheld, and we'll give you what's left. And clients love that idea because they understand exactly what's going on. They understand that they owe. They know that they owe. They want to know that it's been taken care of. They want to make sure we get paid because, well, they're honest and they think we're a valuable service, but they can't afford to pay us cash up front because they don't have it. So these are the steps that I follow through on. So there are phone numbers for FMS. There are phone numbers for IRS collections, and I keep those handy and on my wall, actually, for people to call whenever they need to. All right, so let's move past that FMS and IRS debt collection onto what happens when you do have a debt, but it's not yours because you're married to the person who owes it. And this is where we get onto a subject called injured spouse. An injured spouse is a person who files a joint return with a partner who owes the government money. And that tax return has a refund on it, and it's their refund, but they're not getting it because the government's taking their refund to pay their spouse's debt. Would that upset a few people? Okay, well, there is a solution, and it's called injured spouse. And the rules for injured spouse are very specific, but I'm going to move down to a summary of what those rules are and leave the details of the form and the form instructions for you to read on your own. I wanted to scoot down to innocent spouse. Now, I've just finished saying injured spouse. Now I'm talking about innocent spouse. Are you confused? Most people are. A, they didn't know there was such a thing as an injured spouse. B, they didn't know that there's a thing such as an innocent spouse. And C, there's a difference. There's an enormous difference. So let's look at what an injured spouse relief applies to. Injured spouse relief applies when you have a married couple who file a joint return for the current year. And one spouse, the non-injured spouse, owes a debt to the IRS or to another agency collected on through FMS. And the other spouse, the injured spouse, does not have a debt with the IRS or another agency collected on through FMS. And the injured spouse is due a refund on his or her share of income, credits, and withholdings, which will be used to pay the debt of the non-injured spouse. In this situation, the injured spouse can file Form 8379 to protect and receive his or her share of the refund shown on the joint tax return. The injured spouse form can be filed with the tax return electronically, or equally as often, it may be the case that my client comes into me and says, my refund never came. So we do all of the obvious things. We can log into the IRS system online and look for the status of the refund. And if the refund has been garnished, there's usually some kind of code there. And you identify the code, and then you call in, and sure enough, the IRS is saying, yeah, it was sent to FMS, it was offset. So you call FMS, and you determine that the refund was garnished to pay the debt of one spouse, but the other spouse has no debt. Now you look at the tax return, and you say, okay, is the injured spouse able to show that any portion of the refund is theirs? So if you were to file them separately, would they have a refund? And if so, how much would that refund be? And so what the injured spouse form does is it has you divide the income, deductions, dependents, credits between the spouses to show how much of those benefits goes to the injured spouse. And if that form is filed with the tax return, it can go out electronically, but very often you don't know that the form is needed until the refund has been garnished. So for that reason, the form can also be mailed in as a paper form separate from the return. It has space at the bottom of page 2 for a signature. Okay, let's compare that with innocent spouse. I did my first innocent spouse return before I did my first injured spouse return. I've done them both multiple times over the years. And I did the first innocent spouse return before they even had a form for it. Back then, I called IRS and was told procedures that involved writing letters and explanations and so forth. And then many years later, they came up with a form. You may qualify for innocent spouse relief if you signed a joint return sometime in the past, and the IRS has determined that tax is owed on that joint return because the return showed tax was due and it wasn't paid, or the IRS has amended a return that understated the amount of tax, and you can show that the understated tax is due to erroneous items of your spouse or former spouse, that at the time you signed that joint return, you did not know and had no reason to know that there was understated tax. And taking into account all of the facts and circumstances, it would be unfair to hold you liable for the understated tax. So what's an erroneous item? Well, an erroneous item is things like deductions, credits, withholdings, or payments that are incorrectly stated on the return, as well of course, any income that is not properly reported on the return. When you file a joint return, the law makes both you and your spouse responsible for the entire tax liability shown on that return. That is called joint and several liability. If you sign a joint return with your spouse and the IRS comes along later and establishes that there was an underreporting of income on that return, and you had no knowledge about the income because it was your spouse's income and your spouse never told you about it, then you're innocent of that. But if you knew, we hope no one catches on there, love, and you signed the return, well, then you're not injured. You're a co-conspirator, you could say, right? So you have to be able to show that you're innocent of it. So what does joint and several liability do or apply to? Well, it applies to the tax liability that you show on the return, as well as to additional tax liability the IRS determines to be due, even if the additional tax is due to income, deductions, or credits of your spouse or former spouse. Now, what often happens in divorces is tax returns have been filed for earlier years and the taxes have not been paid. And there's the feuding and the fighting going on in the lawyers' offices, and finally it gets in front of the judge, and the judge says, husband, you're going to owe the tax. That's a part of the settlement. You're responsible. So the wife goes, I'm out of that hole. I'm going to go into April's tax service and file my taxes, and all of a sudden my refund's gone. Because the IRS does not really care what that judge said. The IRS cares that you filed a joint tax return with that spouse that showed a liability, and it's yours. And IRS will take that money from whoever it can get it from first. Now, there are some relief provisions in place for certain situations. Even in the divorce situation I described, there may possibly be some relief from that. This class is not about all the ins and outs of innocent spouse, but I did want you to understand what an innocent spouse application is and the circumstances under which it will be could possibly be accepted. Now, the innocent spouse applications I put in that were accepted, and these were like 15 years ago, I had a rash of them for some reason. I had a woman who had separated from her husband for many years. He was a fisherman. He was gone. She had never seen him. And somewhere, the IRS decided she owed money on his income. And it could have been on an earlier return filed jointly with him maybe 5 years or 10 years before I ever saw her. But it would finally come to her, and they garnished her refund. And she was a single mom. He deserted her and left her with her 4 kids, and now the IRS was taking her money to pay his debt on a tax return she signed years ago. We got her money. Okay, that's the type of situation it's intended for. Now, there's also a new rule that just came into effect. In fact, it was just released as an IRS announcement or notice this month, January of 2012, Notice 2012-8. The IRS has announced that it will use proposed new procedures that will expand how the IRS will take into account abuse and financial control by the non-requesting spouse in determining whether equitable relief is warranted. Innocent spouse relief may now be granted in cases where a taxpayer signed a joint return but did so because they were abused or lacked financial control. For more information on innocent spouse relief, there is an entire publication devoted to the topic, 971. Okay. Okay, there's a question in the classroom about injured spouse, and we're back on page 151 looking at item number 4 here. The statement is that the injured spouse is due a refund on his or her share of income credits and withholdings, which will be used to pay the debt of the non-injured spouse. So essentially what we're looking at is you can have a joint return, but you're a housewife, you had no income, and the entire refund on that tax return is due to your spouse's income withholdings. You're not going to be able to claim you're injured because if you filed without your spouse, you'd have no refund. So you have to show that independently you earned the money necessary to qualify for a credit. That's what that's about. So innocent spouse is a 3-page form. Lots of questions and inquiries about your family situation. You're really providing testimony to the IRS that you are innocent and should be given relief. Okay, so, well, we talked about what happens when you have a refund but you're not getting it for all the various reasons we covered. Now we're going to move on to, well, what happens? I owe, and I can't afford to pay what I owe. How often does that happen? Well, that happens a lot, yes. And it's the opening paragraph. Because of the current economic recession, many taxpayers will not be able to pay amounts owed with their 2011 tax returns. The IRS offers taxpayers the opportunity to enter into an installment agreement or a partial payment installment agreement. Tax preparers should be aware of the 2 plans and the criteria for each. So IRS appreciates it when we as tax practitioners can explain to our clients how to pay. And we sometimes have clients come into us, and the only reason they came into us is they figured their tax on TurboTax and they owe and they can't afford to pay it, so they want us to help them with that. So their clients expect us to understand these rules. And again, when I have any member of my staff who doesn't understand what the rules are, it's a hardship for my business and for my clients. And because I see over 20 years of experience that I've had staff who don't understand these rules and clients who've complained that my staff has not understood these rules, not necessarily today, but over time it's come up, I know it's a problem everywhere. So clients and when they owe, they need to pay. And if they can't afford to pay, what do you do for them? How can you help them? Well, there's different options out there, and the most obvious and simplest of these is an installment agreement, and you request an installment agreement on Form 9465. Now, for the 20 years I've been in taxes, it has been my policy to have no charge associated with this form. I'll give it to you for free. So if I prepare your tax return, and you've paid me for preparing your tax return, but you can't afford to pay, the bonus is I will help you set up an installment plan. So you file this form if you cannot pay the full amount due with your return. You can ask to make monthly installment payments for a full or for a partial amount. Interest and late payment penalties are charged by the IRS until such time as the amount owed is paid in full. A user fee also applies if the IRS accepts the installment. To ask for an installment agreement, use Form 9465, and you should make the request within 30 days of basically receiving the IRS letter saying, where's the money? You can file it with the return. You can file it later after the return's been filed. Sometimes a tax return that showed no balance due when it was filed is subsequently audited by the IRS, and the IRS after the audit establishes that you owe, and you don't have it because, well, you spent the money, right? So in those situations, that can mean that the IRS auditor is giving you an installment agreement at the audit table as you're signing off that, yeah, you really do owe. I've seen that. So how much is the application fee? Well, it's $105. That is an increase. It was set at a much lower figure, $43 for many years, and then before that it was no fee at all. But the IRS, I think, has gotten tired of people filing for installment agreements when they owe $50 or when they owe $200. So one of the mathematical equations I do is if when you file your tax return, you owe $1,000 that you can't afford to pay, the late payment penalty is 5% or $50. You're better off not asking for an installment agreement. If you can maybe go 2-3 months and come up with the money and just send it, it'll cost you less. The penalty for late payment is less than the installment agreement fee. But when you get to bigger numbers, and even if it is only $1,000, but they won't have the money, the most they can do is $50 a month for the next 3 years, then you're kind of left with an installment agreement. But the IRS does have a lower $43 payment option, or payment charge, or fee, that's the word, a lower $43 fee that is assessed for lower income individuals, and they determine whether or not you meet the requirement for the lower charge or whether they'll make you pay the higher charge. Now, if you voluntarily set your direct payment option up with the IRS for electronic funds withdrawal, that means on a specified day of each month, the IRS will just suck that money out of your bank account. They'll only charge you $52. But if you're relying on them to send you a monthly bill and to pay that monthly bill, they want their $105. The $105 is a one-time fee. No, $52 is a one-time fee. But what does continue to accrue over time is interest on what you owe. Now, if you ask for an installment agreement, you are still charged a late filing penalty, but the penalty is reduced to a much smaller number, like 1 or 2% rather than 5%. So that equation can go in there too. If they owe a lot of money, say $10,000, asking for an installment agreement for only $105 can be a good deal because they'll get a much reduced penalty. The IRS guarantees that an installment agreement will be available to most individuals who owe less than $10,000 or $10,000 or less, as long as for over the last 5-year period you have not failed to file any required tax return or failed to pay the tax on any such tax return or entered into an installment agreement for the payment of any tax. So essentially the IRS says if you haven't filed for the past few years and you owe or you owe more than $10,000, it's not automatic. But my experience is that I've never had a client turned down. Even when they owed $50,000 or $80,000, I've never had one turned down. The IRS seems eager early on to accept these agreements. Now, if you have a client who every year owes and every year asks for an installment agreement and never gets caught up, they've got serious problems, and maybe it's time to send them downtown to the bankruptcy attorney that you have on your, your Rolodex there, in your Palm Pilot or whatever they're called these days. And bankruptcy is an option I do recommend to clients regularly. As a tax preparer, you get to know their financial situation, and if they owe $10,000 and they earn $20,000 a year and they just lost their job and their credit cards are maxed out, bankruptcy is maybe where they should be headed. And they can get their taxes sometimes included in that, sometimes not. The other option that's frequently talked about and advertised on the news in commercials is offers in compromise. Those are not easy to get. They have very specific criteria. Most people do not and never will qualify for an offer in compromise. So for those people who really have no prayer, bankruptcy is sometimes the only option. But if they do have the ability, you think, over time to pay it off, they can keep it under control. They can either ask for an installment agreement or they can ask for a partial payment installment agreement. And a partial payment installment agreement requires that you file financial statements with the IRS where you show the IRS your income, your expenses, your cost of living, the resources and assets that you have available which you could sell in order to pay the taxes. And if after all of that is done, the IRS sees that you have no ability to pay, they can actually put part or all of your tax debt into something called a non-collectible status. If you get put into non-collectible status, it doesn't make what you owe go away. Interest still continues to accrue, but the IRS will not attempt to collect from you. And typically, they'll only revisit your case once every 2 years, and after 2 years, they'll ask you to basically submit more financial statements to establish whether or not you can afford to begin making payments of some kind, or to increase the amount of payments you have been making, or whether they need to go another 2 years before they come back to you. It is potentially possible to go far enough out, like 10 years or more, where it drops off the books completely. Of course, taxes that are 3 or more years old on tax returns that have been filed 3 years or more ago can be discharged in bankruptcy. But taxes that are newer, like if you file a 2011 return that shows you owe $5,000, you don't have it and you're already filing bankruptcy for other reasons, they won't be able to add it in because that kind of debt can't get discharged unless it's more than 3 years old. For more specific information, go to a bankruptcy attorney. I am not an expert on this. This is just what I've picked up over time. Okay, so more information on partial payment installment agreements. Let's move on to some other issues to talk about. Among them is non-1040 updates. Form 941 is the quarterly report filed by employers to report employee wages. And for 2011 and for at least the first quarter of 2012, we have a reduced employee portion of Social Security withholding going on that report. Also, the reform itself has been amended or changed for 2011 and later years. They've added a line, a checkbox line, to indicate whether or not you have received a Section 3121Q notice. This is a notice that is issued to people who run restaurants who have employees who get tips. And the IRS has determined that employees had taxable tips, and now they're coming back to the employer for the employer's share of the Social Security and Medicare tax on those tips. And if the IRS sends you a Section 3121Q notice, you need to check box 5E on the 941 form and pay up whatever they say you owe on that notice. So what's all that about? Well, it has to do with allocation of tips and requirements by employers to collect tip information from their workers. So if you're running a restaurant and you have employees working on the premises of your restaurant where tipping is ordinary and customary, they are required under the law to report those tips to you. And if you run a large establishment, and oddly enough, IRS defines a large establishment as a restaurant that has 10 employees, okay, you're required to file a form, Form 8027, to show the amount of tips that you're collecting or that were collected by your workers. And there's formulas that go on in there that basically say if you are not collecting 8% or more of your sales, then you will have to do an allocation to the workers and pay taxes on their allocations, and also the employees are going to have to pay taxes on those allocations. So that's why that box has been added. It's just part of what the IRS is doing to track down unreported income and make sure everyone's doing their piece. 940 has also got some changes on it for 2011, and of course the Form 940 is due January 30th 31st, 2012. And what we've got is a situation on the Form 940 form where you can claim a credit. So the 940 form is used to figure your unemployment tax that you owe on employee wages that you paid to your workers for the year. And that tax is based on a percentage. It has a maximum amount and it also has a minimum amount. And most people pay the minimum amount, and the reason they pay the minimum amount is because they're also paying unemployment tax to the state, and they get a credit for the state unemployment tax that they paid. But this list of states here paid out more in unemployment benefits than it paid in back to the federal government, or the federal government had to pay out for these states, and it hasn't been reimbursed by these states. And so if you are doing payroll for anybody who has employees in these states, then there is a credit reduction, and you have to attach Schedule A to your Form 940 and use Schedule A to figure a reduced credit. In other words, for most people, the maximum FUTA tax, or federal unemployment tax, owed on a worker's wage for an entire year is $56. And for this year, people in these states will pay more than that. And the formula that you go through will figure out how much more you have to pay. Also, we have a Form 8952, which is a voluntary classification settlement program. Now, if you've been in taxes for a while, you might be aware of the fact that there's a lot of people out there who are 1099ing people who are employees that should really, in fact, be given W-2s. And you may know about this because the employee came to you with a 1099 when they should have had a W-2, or you may know about it because you are doing their taxes or accounting, and you see as the tax preparer or accountant for this client that they're paying out large amounts of money to the same people over and over again, and so you say to them, who is this person? You can, and they tell you, oh, that's my employee Josh. He cleans the kitchen or whatever. Well, you're not allowed to 1099 Josh. You've got control over his work. Direction and control means he's an employee. You should be W-2ing him. Oh, I've been 1099ing for years. I don't want to open up that can of worms. I don't want to get caught. They're going to make me pay all this tax. Or what you talking about? That's the other option that they're going to give you. Well, this is a big problem. It's been going on for a long time, and the IRS has an amnesty program in place on it. So at this point, we have a window in time where employers can come forward and voluntarily tell the IRS that they have misclassified workers whom they have been issuing 1099s to, and they want to correct their mistake and begin W-2ing them. It's a very specific process, and it's a very generous amnesty. The amnesty says, come forward and disclose the workers that you should have been paying on and the amount of wage that you paid to those workers. And for the calendar year that precedes this year, we'll charge you 1% of the wages you paid. And that's your penalty. And you're done. Compare that to the opposite, which is all of the Social Security withholdings that should have gone on, all of the matching Social Security payments that should have gone on, all of the withholdings that should have gone on, that business could be held accountable for if the IRS finds out that they were incorrectly paying those workers and did not come forward under the amnesty. So if you've got a company, for example, that has been paying out $100,000 of pay during the year on 1099s that really belong on W-2s, they can come forward and pay 1% of that $100,000 and basically get a free ticket to behave themselves for the future. But if they wait until IRS figures it out on their own, that amnesty is not available to them, and the IRS can come in and on that $100,000 maybe ask for $50,000 in all of the withholdings and taxes that were not held out and paid into the system, plus all the penalties for failure to report. So it's a very generous program, and information about the program is, of course, available on the IRS's website and in the form instructions. And I'll leave those of you who have clients that this might apply to read through the rest of the details on your own. The next thing in line is the new tax preparer registration requirements. And of course, lots of people are really interested in this. They might be interested because they are a tax preparer who now has to take the new IRS test. Or maybe you're a CPA and you employ tax preparers, and you're wondering, how does this impact me? It impacts everyone. And the first stage of the entire program involves registration. And as of course, by now we should all know that beginning with January 1, 2011, if you are paid to prepare a tax return, you must have a PTIN, period. You can apply for that PTIN electronically, or you can file it by apply for it with a paper form, but either way you have to have that PTIN, and that PTIN must be entered on the tax return that you prepare. That's the first rule. The second rule is how to keep that PTIN. We're in a phase-in phase right now where certain people are getting provisional PTINs. And if you have obtained a PTIN and you are an enrolled agent, or you are a CPA, or you are an attorney, you do not have a provisional PTIN. You have a full-blown original PTIN. You've got the real dandy thing. But if you're a tax preparer who is not an attorney, an enrolled agent, or a CPA, you have a provisional PTIN. And the rule for keeping your provisional PTIN is that you must pass the IRS competency test by December 31, 2013. The test has come online. It started December 2nd of 2011. It finally came online. People were complaining because the IRS had promised a summer release and then a fall release. And technically it came before winter. Winter was December 21st, right? Anyway, it is launched. Now the way it's working is the IRS is saying that beginning April 17, 2012, it will no longer issue provisional PTINs. So if you already have a provisional PTIN, you have until December 31, 2013 to pass that test. There's no limit on the number of times you take that test, but it is $116 each and every time you take it. The test is 120 questions. It is 2 hours long. It is held at Prometric testing centers throughout the United States. I've talked to 3 people who have taken the test. One person is an enrolled agent in Georgia. The other is one of my staff. And the third is a student who graduated from our basic tax course just last month. And that student took the Oregon Preparer exam and the IRS test in the same week. So his story, I was very eager to hear what he had to say because, you know, is it easier than the Oregon test? Is it harder than the Oregon test? I want to know. I want to be able to tell my students what to expect, and people from around the country are kind of wanting to know what to expect. Well, how does a correlation with Oregon matter? Well, Oregon's test has, at this point, a 65% overall pass rate. And that it is an open book test. You get 5 hours to take it. It's 200 questions, open book. You're allowed to bring IRS publications in, and you sit at a table for 5 hours and fill out circles. No. The IRS Prometric test is much closer to a closed book. It's done on a computer screen. You go to a terminal, and the terminal does have the ability to allow you to open up an HTML code version of Pub 17 as well as the Form 1040 instructions. And you have 2 hours to take these 120 questions. Well, my staff member, who is a tax school instructor, said that the Prometric test was easy. The enrolled agent in Georgia said it was very rigorous. And my preparer student, who took both tests, said he felt more confident about his performance on the Oregon test than he felt about his performance on the federal test. Okay, so what does all of that mean for the federal test? Well, the first thing we look at is how difficult is the federal test, but we also have to look at what will be the passing grade. If the passing grade is 50%, that's an entirely different thing than if the passing grade is 75%. In Oregon, the passing grade is 75%. So 65% of students in Oregon are able to achieve a score of 75% or higher and get their license. What will the pass rate be on that Prometric exam? We don't know. No results are being released for the first 60 days, so we won't know until the end of, actually, I guess it would be the first week of February, that the earliest examinees are going to be getting their test results. We do not know what IRS has set as the pass rate. I think it might be a curve. I've heard that the enrolled agent exam has a roughly 30% pass rate, but I don't know if that's true. It's just numbers I've seen in cyberspace with no reference. The deadline for taking and passing the test is December 13, 2013. So we've got 2 years. April 17th is the last day you can apply for a provisional PTIN. So let's just suppose you're not a tax preparer and you come along in, I don't know, June of 2012, and you take a couple of tax courses and you say, yeah, I think I'm going to become a tax preparer. So you apply for a PTIN. The IRS will not give you a PTIN until you pass the test. You're not eligible for a provisional PTIN because you are applying for it after April 17. Yes. Now, what happens if I'm a CPA and I employ staff? Does my staff need to have a PTIN? Does my staff need to pass the test? Well, it's up in the air right now on some of the details. The reason it's up in the air is AICPA in particular has been lobbying the IRS to make it such that CPAs who have staff working for them, that staff shouldn't have to pass the test, because after all, they work for a CPA and that CPA is responsible for the return. As we're sitting right now, the IRS has conceded somewhat and said, if the staff prepares the return but does not sign it because the CPA signed it, then those persons do not have to pass the test, but they still have to have a PTIN. If they prepare the return and they sign the return, then they must also pass the test. Now, I, as an educator in tax law, employ a CPA who works for me. I am an enrolled agent, and I would not for the life of me ever want a tax preparer to touch any tax return if I wasn't confident that tax preparer could pass a minimum competency test. Ethically, I don't even want to go there. And the man who's in charge of all of this, for IRS, who's in charge of the testing program, happened to be at an IRS thing here in Portland a month ago, and I walked right up to him and I said, what is up with this rule? I cannot tell you how dumb I think it is. And he said, I couldn't agree with you more, and the future may bear otherwise than the facts say today. So what he was communicating in that is that right now they're focusing on the core 350,000 tax preparers who are not enrolled agents, who are not CPAs, and do not work for enrolled agents or CPAs. Those 350,000 people are covered. You have to take the test. You have to pass it by December 31st, 2013. Those other people who work for CPAs and enrolled agents, they're not going to have to take the test yet, but in the future, the IRS certainly is reserving the right to change things. Now, the flip side of it, or the extra information with it, is how come IRS is only testing on 1040 law? Well, more tests are in the works. Once they have fully implemented the 1040 program, it is their intention to introduce additional tests, such as a payroll test, to show you understand payroll laws and can fill out payroll forms. And fringe benefits and employee wage reporting I could spend a week training you on that. That's pretty complex stuff. So I think that that's fair that they would eventually test on it, and of course eventually have tests for states, trusts, corporations. But it's just baby steps. They're doing what they can as they can. And, you know, this is an enormous agency with, at this point, 750,000 people who've registered for and have received PTINs. So they're just doing it as they can and bearing all of those facts in mind. So if you want to know a little bit more information about the PTIN system, who's affected, why they brought the laws into place, I have kind of a brief summary of that in our manual. Oh yeah, this is the guy I talked to right here. David Williams is his name. On page 165, he's kind of grumpy. At least he was the day I met him. He wasn't grumpy with me, but just in general, I found him grumpy. But yes, I did. Question is, did I meet this guy in the picture? The answer is yes, I met the guy in the picture, and he was grumpy on that day. Can't speak for him as an individual in general, but on that day. But I didn't care if he was grumpy. I still talked to him. Okay. All right. Also, the IRS will be doing compliance checks on anyone who applies for a PTIN and anyone who renews a PTIN. The compliance check has to do with, did you file your tax returns if you were required to do so? And if you filed them and you owed, did you pay what you owed? The reason being that if you have not filed when you should have, or you not paid when you should have, how can you possibly be trusted to be preparing other people's tax returns? So if you owe and are not involved in an accepted installment agreement, then they won't give you a PTIN. So if you owe and you can't afford to pay and then you went into an installment agreement, that's okay. But if you don't have an installment agreement, you're in and you owe and you haven't paid, they won't give you a PTIN. Next up is continuing education. And oh my gosh, we've been going through that for the last 8 hours today, right? Okay, so what are the rules on CPE? Well, if you are a CPA, you look to your state board of accountancy to determine what your CPE requirements are. Your state establishes those. If you are an enrolled agent or a tax preparer, you look to the IRS for those concerns. And of course, if you are a tax preparer in California, you must also meet CTEC requirements. And if you are a tax preparer in Oregon, you must also meet Oregon requirements. But at the IRS level, these are the IRS rules. If you are an enrolled agent, you have to get 72 hours every 3 years, and you must get at least 16 hours plus 2 hours of ethics every year. So you can't save all 72 hours for the same year. If you're a registered tax preparer, you have to get 15 hours every year, broken down as follows: 2 hours of ethics, 3 hours of federal tax law update, and 10 hours of other federal tax law. So for today's class, we're giving you 3 hours of update, and we're giving you 4 hours of regular. So by the end of 2012, anyone who has to renew their PTIN and is not a CPA, EA, or attorney, you've just got 7 hours today, and you've got to make up the difference somewhere else. So we have other programs, of course, to cater to your needs there. So what's IRS doing with the money that it's getting from all these PTIN fees? Well, some of it's going towards administering the program, and some of it is going to public awareness and service enhancements. And this is the part I'm excited about, because although we've had licensing in Oregon since 1973, the Oregon Board of Tax Practitioners has never had a budget to advertise its existence or inform the public about the fact that preparers here have to be licensed. Therefore, when tax customers walk into an office of an unethical, unlicensed, or incompetent tax preparer, they aren't even aware of who to turn to with their problem. And it's just one of the problems with Oregon's system. Now, California is the opposite. California has a huge public awareness campaign. They spend lots of money on it every year. And so the public in California is informed that they should be looking for a person who is registered and has their little certificate on the wall. Well, the IRS is going to be launching its own campaign, and it starts this very tax season. It's a very, very simple campaign. It contains only 2 messages. One is, if you paid your tax preparer to prepare your return, the preparer must sign it. And the preparer must have a PTIN that they entered on the return. That's the 2 messages. That's huge. So if they go to a tax preparer who doesn't sign the return, that's illegal. If they go to a tax preparer who doesn't put their PTIN number on the return, that's illegal. That's a start in and of itself. But once the system is fully implemented by the end of 2013, we should expect to see in the 2014 season a system whereby the public can go online and establish whether or not a person has a valid PTIN. The IRS has also stated that it will inform the public of the difference between a registered tax return preparer and an enrolled agent. They do want the public to understand that there is a difference, and that tax preparers have only limited practice rights compared to enrolled agents and CPAs and attorneys who have full practice rights. The limited practice rights of a tax preparer are: you are allowed to prepare the tax return, you are allowed to sign it. If your client gets a letter from the IRS regarding a tax return you prepared and signed, you can represent your client regarding that tax return. That's it. If you're not an enrolled agent, CPA, or an attorney, you do not have the ability to represent your client before the IRS regarding tax returns you did not prepare. So in any office, that's going to be a big deal. Let's say someone walks into your company and you're a registered tax return preparer, and they have a problem. They're getting audited on a return that they themselves prepared, and they've never had a tax preparer before, but they want you to help them. You could maybe give them a little bit of advice on it. You could maybe help them amend it, but you couldn't represent them before the IRS because you did not prepare it. If you want to be able to represent your client before the IRS, you need to become an enrolled agent. So that's what that's about. I beg your pardon? There's a question in the classroom, how many states have licensing laws? 1, Oregon. There are 2 states with registration, actually 3 states with registration laws. There's California that requires registration, New York requires registration, and Maryland requires registration. New York's registration is give us your money, $100. California's is you have to take a 60-hour course, but there's no test. Okay? And give us your money. And Maryland was going to introduce its own test, and Maryland's new law that created a licensing program for Maryland did have a test requirement, but interestingly no education requirement. So Maryland's proposed laws are more similar to what the IRS has enacted than anyone else's. But as soon as Maryland found out the IRS was conducting its own test, they're deferring to that. So the only requirement for Maryland registration at this point is that you have a valid PTIN. So Oregon is it. Yes. Okay. Next we're going to talk about the tax preparer e-file requirements. For 2012, if you prepare and file 10 or more tax returns, you must file all the tax returns electronically. This includes 1040 series returns and 1041 series returns. That's it. Now, there is a question that came up that was discussed at the IRS forum that I was at. Brian Wozniak is the IRS liaison here in Oregon, and he was talking about how after the season ended, he got a list of people who had filed tax returns that had PTINs but had not e-filed them. And he started calling them. And he got hold of a tax preparer in Alaska. And the Alaskan guy said, you know, hey dude, my clients are out in the bushes. I get in my plane and I fly out into the middle of nowhere and I prepare their return, and there is no way in heck you're going to talk me into e-filing. And I refuse to participate in this program, and by the way, it does not cover me because my clients mail the returns in and I do not. And Brian scratched his head and said, but it says you have to do it anyway. Well, I don't care. Take me to court. Sue me, he said. Then we clock forward, and I start actually reading the form instructions and so forth, and it does say that you have to e-file if you file 10 or more returns, not if you prepare 10 or more returns. Now the thing is, if your PTIN's on the return and you signed it, how does the IRS know whether you put the stamp and put it in the mailbox or whether the client put the stamp on it and put it in the mailbox? There is an opt-out form, and last year we did have a few situations in our company where clients could not e-file. I don't know if we had any situations where the clients absolutely refused to e-file, because in our office we said, we had one client in our office who refused to electronically file. And if that happens, there's a form that you fill out and attach to the form, or to the tax return, and you also have to get that client to sign a written statement, and the written statement is the wording of how that written statement should be worded is in here. Let me just get to it. Here's the form. Prepare explanation of why the return was not e-filed. Then we go down, and this is the second procedure. So procedure number 1 is attach the Form 8948 to the tax return. Procedure number 2 is to get your client's signature on a piece of paper. And the piece of paper needs to say, my tax return preparer named blank has informed me that she or he may be required to electronically file my 2011 income tax return. If he or she files it with the IRS on my behalf, I do not want to file my tax return electronically and choose to file my return on paper forms. My preparer will not file my paper return with the IRS. I will mail it myself. This is page 173 of the manual. So I'm not sure exactly how IRS would know whether you mailed it or the client mailed it. So quite frankly, whether the client mails it or not, you seem to need to have the form. Do you see how the rule is confusing? The IRS is interpreting the word file as prepare. And because they're interpreting as prepare, well, I'm interpreting as prepare. But if you want to be out there as a tax preparer and say, well, I didn't technically file it, then you can deal with the IRS when they call you. Yeah, that's true. And there is actually, yes, the preparer is covered if he prepared the statement and had his client sign it. There's also a separate procedure that you can go through to apply for hardship to say, I can't e-file. Or I shouldn't be forced to e-file on religious grounds and things of that matter. And I have more information in the manual here. For any of you who are concerned with that, you can see if you qualify for one of those exceptions. Minutes left. I'm going to power through the last couple of things I need to cover with you. The first one is Modernized E-file. Whether you know it or not, the IRS has moved over to a new system of electronic filing, and it is great. The old legacy system of e-filing was in place for over 20 years, and it was very restrictive in how it took tax returns in and how quickly the IRS could process them. And the way it used to work is the IRS had gates that it opened twice a day, sometimes 3 times a day, where it would take in tax returns and then the gate would close. And all of the tax returns you were transmitting would back up, waiting for that gate to open. It would open, the IRS would swallow them, and then it would start processing them. And sometime between 12 and 24 hours later, you would get an acknowledgement that the IRS had the tax return and had accepted it or had rejected it. Those acknowledgments take seconds now. You can transmit that tax return and a minute later have an acknowledgement. It's that fast. The other benefit of Modernized E-file is that it allows the electronic filing of back year returns. If you're working with a software provider who operated with software accepted through Modernized E-file in 2011 for 2010 returns, it is still possible to electronically file some 2010 returns. The other thing that's going on is that if you need to amend a tax return, the window is opening up in the near future where it will be possible to electronically file amended tax returns. It is already possible to electronically file amended corporate and partnership returns. At the individual level, it may or may not be possible. It depends on the software provider that you used for the earlier year. And very few software providers participated in the 2009 season. More software providers participated for the 2010 filing season, which was just last year. And this year, again, Modernized E-file is hopefully in its final stages, where they're going to be accepting virtually every tax return through the door under Modernized E-file. And if that's the case, then we would be able 3 years from now to electronically file an amended 2011 return, and that would be absolutely awesome. So the last things in here, penalties affecting information returns have gone up. Failure to file or filing late. And then at the very end, I threw in a little bit about the changes to Forms 1065, 1120S, and 1120. Mainly they have to do with those same lines being added that we saw on Schedule C. That is, they're adding lines to break down income reported on Schedule K and or 1099K and all other income. Also, there used to be a Schedule A that was attached to corporate and partnership returns to report cost of goods sold. Schedule A has been removed and has been replaced by a separate form called Form 1125A. So you'll notice a change there if you do those types of returns. There's also a question on when you prepare a partnership return, there are 2 pages of checkbox yes and no questions that you need to answer. There are 2 questions that have been added for 2011, and they have to do with the 1099 requirement and U.S. persons with certain foreign corporations. And then on Form 1120, it's much the same changes, just as they affect the 1120 return. And I have the final password of the day at 5:02. I'm sorry I ran over. The final password of the day is Lynx, L-Y-N-X. It's a fuzzy cat with tips on its ears and big feet. Lives in Canada. I love lynx. They're so pretty. Okay. So those of you who are online students, class is over. You need to return to the LMS and take your password test. When you pass the password test, you can print your certificate of completion. I'm going to go to our website where you have the login button, and then you need to log into the LMS. LMS stands for Learning Management System. And I'm going to scroll down to the course that you're enrolled in today, which is the Federal Tax Law Update. And you go inside and you see my picture, and then you see these tabs. And of course, the Course Manuals tab is where you go for the student manual. It's right there. Forms and Publications is where you go for forms. Join Webinar is how you got to me. Tab number 5 has tests. And you will see that there's the password quiz, and that's the mandatory test. You need to get 100% on it. All of the passwords should be lowercase letters. Do not put any caps in there. Underneath the Answer Keys tab, this course does not have answer keys yet, does it? Oh, there is an answer key. So after you pass the course, if you want to, you can actually go and open the answer key to see how you did. And the answer key is password protected. In order to get the password to unlock that answer key, you need to open and print your certificate of completion, which is right here on the completion certificate page. And you just scroll to the bottom and click certificate, and the certificate will open, and you can then print that certificate. Thank you. And the certificate has a password on it that you can use to unlock that answer key. And there's also a survey for our course, which we hope you enjoyed. So are there any other questions for me today? I do see a question from Robert Blake. Do I have any other live webinars in the next week or two? The answer is, well, I have one on Oregon tax law, but I'm sure that doesn't interest you. And then I become a tax preparer for tax season. That's what I'll be doing. And then I'll pick up classes in May. So I will teach for several weeks straight, beginning in May, probably all the way to close to July. But between now and then, we have probably 24 self-paced online courses available, all of which have webinars that were recorded. So if you enjoyed the webinar format, self-paced online is really, really similar. You just can't text me because obviously it's a recording and not live. So did I answer your question, Miguel? Yes. Okay, good. All right. Question from Jenny, aren't you doing one for California? The answer is yes, because of you, Jenny. I'm doing one for California. And as soon as it's done, I will let you know.